Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That's Diane King Hall. Brad Smith is on assignment. And here are three things that you need to know this morning. Fed Chair Jay Powell testifies before the House Financial Services Committee today and the Senate Banking Committee tomorrow. He'll tell lawmakers that nearly all Fed members do expect to raise rates this year. That's after the central bank took a breather this month with the so-called hawkish pause. Powell will reiterate that the process of getting inflation back down to 2% has a long way to go. And in fact, we're across all the Fed speak, including our own exclusive conversation with the Federal Reserve Bank of Atlanta President Raphael Bostic this afternoon. Our own Jennifer Schonberger will be speaking with him. Another shock inflation reading out of the UK, with the core figure jumping to a 31-year high of 7.1%. That number's boosted bets for more rate hikes from the Bank of England to keep a lid on price rises. Traders are now assigning a 35% chance for a half-point hike on Thursday. The BOE, not the only central bank that could opt for a bigger move on rates in the coming days. The Swiss National Bank and Norges Bank could take the same step as they battle sticky price increases. And FedEx not delivering the goods, the economic bellwether slumping in pre-market trading after missing the street with its outlook as weakening demand bites. Fourth quarter sales falling 10% to $21.9 billion. That's a third consecutive decline. Analysts are not all, though, turning bearish. Citi and Raymond James both holding their buy ratings on the stock, saying they expect shares to tick higher.
From FedEx back to the Fed. Fed Chair Jerome Powell could move markets today when he testifies before the House Financial Services Committee for his semi-annual report on monetary policy. Joining us now with what we can expect from today's hearing is our own Jennifer Schonberger. Jen, take us through it.
Diane, Fed Chair Jay Powell will reiterate in opening testimony before the House Financial Services Committee this morning that nearly all Fed officials expect to raise interest rates higher after taking a breather at their policy meeting back earlier this month last week. Fed Chair Powell will say in testimony, quote, nearly all FOMC participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at last week's meeting, considering how far and how fast we have moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. Powell is set to deliver his semi-annual two-day testimony to Congress today, Wednesday, and Thursday. Powell says inflation is still running high, even though it's moderated since the middle of last year. He says the process of getting inflation back down to 2% has a long way to go, and that it will take time for the full effects of higher rates to be realized, especially on inflation. Powell reiterated that the Fed will make decisions on interest rates meeting by meeting based on the data. Officials will have another jobs report, inflation report, and bank earnings by the next policy meeting at the end of July. Separately this morning, on the other side of Capitol Hill, the Senate Banking Committee is holding a confirmation hearing for President Biden's nominees for the Fed. Fed Governor Philip Jefferson, nominated to be elevated to vice chair of the Fed, said the economy faces multiple challenges, including inflation and banking sector stress in opening testimony. Meanwhile, Fed Governor Lisa Cook, nominated to a new term, along with new nominee Adriana Kugler, both say they are committed to bringing inflation back down to the Fed's 2% target. All of this getting underway on Capitol Hill at 10 a.m. Eastern. Back to you.
And of course, we have that testimony. We'll be monitoring the questions he has asked and his responses very carefully. Thank you so much, Jennifer Schonberger. Appreciate it. Well, the Fed is still quite hawkish. Fed Chair Powell saying that nearly all participants expect to raise rates later this year, as we just heard. Charles Schwab points out that most investors have yet to price in more tightening. Joining us now on this, Liz Ann Saunders, Charles Schwab Chief Investment Strategist. Good morning, Liz Ann. Good to see you.
Good morning. Good to see you too, Julie.
So what would that pricing in process then look like for more rate hikes to happen? In other words, have stocks gained too much if indeed the Fed is going to raise once or twice more?
I'm not so sure it's additional hikes that would be tough for the market to digest. It's still the case that market pricing has in a cut toward the end of the year. And that's where I think there's the significant disconnect. In advance of the most recent, the June FOMC meeting, you had priced most of the cuts out, but not all, and that hasn't really changed. So I think it's more the high or higher for longer. I'm not saying it doesn't matter if the Fed goes one more time or two more times. I think if the data justifies a move, meaning both stickiness on inflation and some shift in what has been a disinflationary trend and or continued strength in the labor market, I think the market would probably be okay with a hike. It's just a question of the longer component of the Fed standing pat for a more extended period of time. I think that's what the market is not fully digested.
So, yeah, Liz Ann, just in follow to that, of course, we know inflation has been sticky. The last PCE reading, which is the Fed's preferred measure, was above 4%. We've got the next one coming out next week. And of course, we have a new jobs report coming out in a couple of weeks. We know this is a data-dependent Fed. And based on the dot plot from the last meeting, it looks like there would be 2 more hikes this year. Do you think the conditions warrant that from what you see?
Well, because they're data dependent, and you rightly pointed out that we've got a lot of data between now and then, the answer is we don't know. The dots plot does not represent a forecast. It does not represent anything resembling a predetermined path. It's just, at the moment that those surveys are done, what the members believe the Fed funds rate is going to be. The dots plot in many times has not reflected the reality of what the Fed is going to do. So I think it really is dependent on the data. But you also rightly point out that it's the combination of inflation data and labor market data. Excuse me. For much of the first year or so of this cycle, the focus was almost solely on inflation. Now I think both sides of the Fed's dual mandate will come in clearer focus. And back to what I said before, this notion that if inflation continues to come down, that alone is key to the Fed pivoting to rate cuts. I don't think that's the case. I think it would have to be something, maybe not calamitous, but much more significant deterioration in the economy, specifically the labor market, in conjunction with lower inflation, that would say to the Fed, okay, you can actually start cutting rates. So if you told me what the data is going to be, I'd have a better sense of what the Fed's going to do in July. But they are flying by the data, not just on some predetermined path that they're just deciding when to share that path with us, lowly Fed watchers.
Well, we don't know what the data is going to be, but we do have leading economic data, right? And that's something that you've highlighted, Lizen, in a chart that you shared, looking at the leading economic indicators and what's happening in terms of whether that indicates a recession. And we're pretty much at recession levels now, it seems, right? So.
Oh, no question about it. Whether it's the number of months we've been in decline, the percentage of decline in the leading indicators from the high 16 months ago, obviously the inversion of the yield curve and the duration thereof are all screaming recession. Now, to say they're wrong, and we obviously don't have one, I think it's premature to say that. We know that the NBER, in making their decision about not only is it a recession, but then simultaneously backdating the start. We have to remember that when the NBER dates the beginning of recessions, they go back to the peak in the aggregate data that they're tracking. So if you were to sort of snapshot that moment in time, a peak in the data suggests the data looks pretty good, whether it's payrolls or industrial production or personal income or business sales. Those are the 4 key components. So I think the LEI is clearly flashing recession. It hasn't yet obviously shown up in the numbers, and that's in part because the economic components of the LEI are more manufacturing driven. And this has been a unique cycle, this rolling recession idea, where manufacturing has already gone into contraction. It just yet hasn't hit services. So I think that's the disconnect between what we see real time in the economy and what's picked up by an indicator like the LEI.
But Liz Ann, do you think it could just be sector specific? Because we have definitely seen some analysts and economists kind of dial back their expectations for recession. We've had Goldman's econ team put out a note dialing back their expectations of seeing a recession to just a 25% expectation. So where do you stand in your view on that? I mean, could we really see that this year?
Well, so again, we've been talking about this notion of a rolling recession for about a year now, and there's no denying that segments of the economy have gone into recession. Housing related, manufacturing, a pretty decent component of consumer oriented products that were big, lockdown, stay at home beneficiaries. It's just it was offset at that time of most significant contraction by the strength in services that came later in this unique pandemic-driven cycle, which is why I've been saying is it going to be a recession or a soft landing debate kind of misses the nuances of this cycle. To me, best case scenario is not really a traditional soft landing because we've had hard landing in those aforementioned areas. It's a continuation of the roll through where if and when you see services get hit, and there are some cracks starting to show that you've got offsetting stabilization or improvement in other areas, in some of which we're seeing now in an area like housing. I think ultimately there's a greater chance, yes, that down the road the NBER will say, okay, it was a recession, here's when it started, eventually here's when it ended. They're always so late that I'm not sure that is really what matters in terms of just perception by Main Street folks as well as the stock market. I think seeing this lift in housing could be a welcome offset to if services weaken further from some of the cracks we're seeing on the surface.
Okay, well, stay with us, Liz Ann Saunders. We are almost halfway through the calendar year, and it's safe to say a lot has happened so far. Tech stocks surging this year as a wave of interest in AI is making investors bullish on the sector. The Senate voted to approve a bill that raises the debt ceiling for 2 more years, and the Federal Reserve paused its campaign of interest rate hikes, marking the first break after 15 months of consecutive increases. But are we out of the woods just yet? Liz Ann Saunders, Charles Schwab, Chief Investment Strategist, is still with us. So are we out of the woods yet? You just talked about, kind of some of these indicators, and of course, NBER kind of when they assess whether it has been or is a recession, it can be often backward looking. So are we out of the woods yet?
So for the economy, no, I don't think we're out of the woods yet. As I mentioned, we're starting to see some minor cracks in services, certainly witnessed in a metric like the ISM non-manufacturing index, which, by the way, covers more than just services. A lot of people don't realize that ISM manufacturing is just the manufacturing sector. ISM services, which is formerly called non-manufacturing, is everything else other than manufacturing. So it's a pretty broad look, but that dipped more than expected and is sitting just above that sort of expansion contraction line. The rub of services getting hit more is that they're a larger employer. And so I think the labor market hit is still yet to come. And I think we're sort of at a moment of truth here for companies as they look at what many perceive to be pricing power was really just directly tied to higher inflation. So you had very strong nominal revenue growth, but it was more than all accounted for by inflation. There hasn't been any real revenue growth over the past year or so. And now that inflation is coming down and other costs are coming down, but with it demand, companies are going to say, how do we protect our margins? And for many companies, the largest cost is on the labor side. They've been hesitant to do it. There's the labor hoarding notion, I think, has validity, but they have been cutting hours. And I think now we're at sort of that moment of truth to see whether companies will maintain that confidence that eventually we'll see a pickup and maybe even take the hit in profit margins by maintaining worker roles to the same degree that they have in the recent past. So I think the next month or two, especially with second quarter earnings season coming up, I think what companies are saying about their cost structure, specifically labor, will be an important tell whether that is the potential proverbial next shoe to drop.
Yeah, I mean, that's a really interesting question, too, because are they sort of so traumatized by the difficulty finding labor during the pandemic and after that is going to inform the decisions they make now? I want to zero in on profit margins, which you just highlighted. There have been some prominent calls lately that have said we're going to see a pretty steep tumble, perhaps a double-digit tumble in profits from here through the end of the year. Do you see that happening? And then how is that going to inform what we see on the stock front?
I think the path of least resistance for the second half of the year in terms of consensus estimates is probably still lower. When you look at the historic relationship between things like lending standards, PMIs, moves in the 10-year yield, they all track pretty closely subsequent trends in earnings with different lag times. And it suggests that at least second half of the year estimates are probably a little bit too high. Now, overall calendar year 23 estimates have been trending higher, but that is all accounted for by the better than expected first quarter earnings season, where analysts just set the bar too low, companies exceeded those expectations. So a lot of people, when they look at 2023's estimates coming up, they think, okay, the clouds have parted, the skies are clear. But second quarter, third quarter, fourth quarter estimates have all been coming down. There's just been a bigger adjustment associated with what has already been reported. And I think the other unique thing is that, remember, during the pandemic, a record percentage of companies withdrew guidance altogether. They just said, we're not even going to try to be precise with guidance to our analysts because of the unique uncertainties associated with the pandemic. Now, companies have picked up in terms of those providing guidance, but they're doing it a little more kind of loosey-goosey. And I think many companies are using the pandemic as an excuse to say, we're not going to go back to that game of quarterly guidance to the cents, because that's not how companies run their business. The result of all of that is I think analysts are not making adjustments too far out. They're making adjustments maybe a quarter out, particularly when they're hearing from their companies during reporting season. So they might adjust the next quarter's numbers, but kind of keep their cards closer to the vest until they get more direct earnings season commentary from companies. So that forward consensus might not be as, for lack of a better word, valid as it has been in the past.
All right, Lizanne, I want to just expand this conversation a little bit in terms of the impact to the market. We've seen the market head into a bull run. The S&P is doing better than a lot of people expected earlier this year, and certainly breaking out of certain technical levels. In terms of where the rally is headed, do we think this is kind of a head fake, or do we expect more participation from, say, the small caps? What's your view?
So we've started to see improved participation, but we definitely need to see more of that. When May ended, you had only 15% of the S&P was outperforming the index itself over the prior 3 months. That was a record low, even exceeding what was seen as a very concentrated market back in the 1999-2000 period of time. And yes, we have started to see a pickup in breadth, but not for a long enough period of time, nor has it surged enough that you can breathe a sigh of relief. It's also the case that we're in a so far improving breadth environment, but with the market having done very well, technically overbought, and sentiment conditions starting to get fairly frothy. That's, I think, importantly in contrast to what was happening in October, where the indexes like the S&P and the Nasdaq took out their prior June low. So on the surface, it looked pretty ugly, but breadth under the surface was actually improving. That kind of positive divergence is sort of the best of all worlds, because you don't have the overbought market, you have negative sentiment, which acts as a contrarian indicator. So I think we do need to see more broadening out, because a market that is driven by, in this case, just 7 stocks, if the other stocks are significantly underperforming, not just kind of hanging in there, that's when you get a bit of risk of convergence. So I like the broadening out, but I think we need to see more of it.
We'll see if it happens throughout the summer. Lizanne, always good to catch up with you. Thank you. Lizanne Saunders is Charles Schwab,
Thanks.
Chief Investment Strategist. Have a great one.
You too.
FedEx shares taking a hit today after the company posted revenue that dropped for the 3rd straight quarter as the shipping giant aims to adjust to weaker demand. FedEx also set its full-year profit forecast below expectations despite its $4 billion cost-cutting plan. Scott Schneeberger is joining us now, Oppenheimer Managing Director of Equity Research, who focuses on the transports like FedEx. Scott, it's good to see you. Thanks for being here. The question I guess I've had with FedEx for a little while here is how much is what's going on with the company a product of the wider economy, and how much of it is FedEx still doing its sort of reorganization? How should we be looking at this quarter through that lens?
Yeah, I think it's a lot more the latter. The economy's obviously been challenging over the past fiscal year. FedEx's fiscal year ended in May, and it was back in in the fiscal first quarter, where the company had a negative pre-announcement, the revenues were still hanging in, although they started to see deterioration there, but they significantly underperformed on their margins. So that prompted them to enact significant cost cuts, which they have been doing. They've been announcing them throughout this fiscal year. And that culminated in a big event back in April with them speaking to their DRIVE initiative, which is $4 billion of structural cost removal. So it's a lot more about what they're doing internally than the macro environment. But that said, the macro environment remains challenging. So their guidance that they just provided last evening is contingent upon different scenarios of what demand and volume will do over this upcoming fiscal year.
Scott, I got to ask, are your thoughts about labor when it comes to FedEx? They don't deal with the same issue that, say, a UPS has, such as UPS being a union shop. But it can be, we know that UPS is kind of going through negotiations right now with their union. Their union voted to authorize striking, not striking. And it could send signals, say, to FedEx in terms of what kind of earnings or pay that they're looking for their employees. How do you feel about labor conditions at FedEx?
Yeah, it's an interesting dynamic right now. So with the coming up in the next couple months, will be this renewal of a 5-year Teamsters contract over at UPS. FedEx has been active in trying to recruit new business, new customers. They did not provide any guidance, or they said it's not included in guidance, any incremental wins. We sense that they did get some incremental wins. With regard to labor, yeah, you're right. There's been a lot of inflation, obviously labor inflation as well. That's going to be addressed by UPS. And simultaneously, this has to be addressed by FedEx too. So that's a headwind that they're fighting on the cost side while they're taking out costs. So it's a balancing act over at FedEx. Another interesting thing FedEx is doing is they are basically aggregating their express and their ground business over the coming years. They're just at the very beginning of that process. And they have a couple different business models on how they compensate employees. So there's all of that coming together over the next couple of years too. So labor compensation is a big issue at both companies right now. And we'll see how it's managed with FedEx. It seems like they're doing a nice job on their expense takeout. So I think they're staying ahead of this a good bit on the margin line. Their margins are relatively low after some negative issues over the past year. So that's on a turn, but I think we're going to see the margins net improve over the upcoming fiscal year.
And in terms of jobs, the company shared that they had cut about 29,000 jobs over the past year from the company as part of this whole cost-cutting quest. What do you think is the right size for FedEx when it comes to that? Is there more cutting to come? And obviously they have more to go in their overall cost-cutting plans.
Yeah, I don't know what the right number of employees is exactly. Obviously, automation over the years has contributed to this as well. But it's just FedEx is shrinking its business right now because it had overbuilt during the pandemic, a lot of activity. So this is kind of the hangover period thereafter. They are bringing down costs on a variable basis of business activity that may come back, but they're really focused on structural reductions. So I don't know what the right number is. I do think we will see a lot more to come over the next few years. They've certainly guided that with these initiatives. And I do get the sense that there probably is some upside to expense reduction. I don't know if it'll be labor or elsewhere, but I think that they're very focused there. And if anything, there's probably more to come than what's been publicly stated thus far.
Hey, Scott, just quickly, you sound relatively optimistic that they're going to be able to improve margins and get this cost cutting done. You're perform on the stock. You're now perform on UPS, I believe. I'm just curious, what would change your mind on FedEx? What would unlock that next step up for you?
Yeah, that's a good question. Historically, we've seen FedEx go through a lot of cycles like it's in now, where it overbuilds in a good environment and then is forced to do a cost reduction initiative. So this is a bit of a deja vu. They are, as I mentioned earlier, consolidating express and ground over time. So this may be the time where they really get some good structural efficiencies and it works out. But in our view, it's a bit of a show me story as they're in the early stages of this. The stock has benefited over this past fiscal year. It's up about 34% calendar year to date. And that's predominantly on these cost takeout initiatives and progress against them thus far. So we view it, it's trading a little bit above its historical PE multiple. It's about 13.5 times on forward expectations versus low 12s. So we're on pause right now. We do like UPS. We feel that it's hitting on more cylinders, whereas FedEx is more of a fixer-upper story. But yes, you're right. Sensing we do have optimism. It does seem like there's a lot of improvement that can be had, a lot of room for margin expansion, a lot of things for investors to get excited about. It's not easy. There's a lot going on here operationally. So we're kind of taking a wait and see approach on this, and I think we need a better economy to help the top line. That would do a lot, and then just execution going forward. We need to see a little bit more
execution and also a change up in the C-suite coming. So we'll have to put a pin in our conversation. Scott Schneeberger, thank you so much for joining us. Oppenheimer Managing Director of Equity Research. Scott, we appreciate you.
Thank you.
As many investors look to FedEx for insight into the state of the consumer, our next guest says the shipping giant can be a key bellwether for global trade trends, including China. And Barry Threadneedle Strategies founder joins us now. So what does this indicate to you, what we've seen from FedEx, especially in the China story?
Well, I think it's consistent with what we've heard, which is the China reopening has not been going at the pace and the acceleration that everyone had hoped. And I think we're seeing that in one of the small data points that point to how trade flows are going.
And so what are the broader implications then beyond FedEx for investors who are not only interested in China in and of itself, but also, of course, how it relates to the rest of the globe?
Yeah, I think it looks to a couple of things, Julie. We've seen a shift towards services and the shift towards the consumer spending on experiences instead of on stuff. And I think this is consistent with a pattern that we're going to continue to see, which is particularly with a high inflation environment, which we still have, where the consumer's looking at every dollar of discretionary income and saying, what do I want to do with it? I think this is another sign that they're going to look again at moving away from buying products and moving in towards services and experiences.
Speaking of that, so inflation has been a problem globally, not just here.
Yeah.
I mean, you have the cost of living crisis just around the world. So does that say to you, because the consumer is being more discretionary with their spending, so we're seeing some impact in terms of FedEx, people not getting as many boxes as they used to, and including you have the China story there. Does that say to you that the consumer is less resilient or going to be tightening their wallet even when it comes to experiences?
I think overall, yes, and I think we're starting to see early signs of that, Diane. So, for example, if you look at auto loan defaults, they're inching back up towards that 2008, 2009 arena. We're seeing it in terms of drawdowns on people's savings. So while so far it's been relatively robust, relative to all of the noise we've heard about recessionary trends, the consumer, I think, is starting to pare back.
And so that does imply that a recession will be coming, right?
Yeah, and we're going to go back into defined recession territory. Do you remember,
right.
Is it 2 consecutive quarters of GDP?
Right.
Look, I have definitely I felt like Cassandra. I always felt there was going to be a hard landing coming. I've moved to thinking actually the Fed is going to pull off the soft landing. I do think a slowdown is coming. It's just not going to be catastrophic, in my opinion.
Okay.
Hope so. And you're going to stick around. We're going to talk about much more stuff, and not all of it about catastrophic things happening, or non-catastrophic. Either way, coming up, why the best investments may actually be pretty boring. We'll talk to Ann about that in a moment.
All right, the opening bell rang on Wall Street a couple minutes ago. Let's do a quick check of the markets. So you're seeing investors cool their heels a bit before Fed Chair Jerome Powell starts speaking today before Congress. You're looking at the Dow down triple digits, down nearly 0.5%. Not too bad there. S&P's down 14, Nasdaq off by 33. So we'll continue to watch that as Fed Chair Jerome Powell gets ready to speak. Meantime, with the possibility of future rate hikes and the threat looming of a recession, so actually, we're going to do a quick check of some of the specific stocks that we're looking at. Julie?
Yeah, thanks, Diane. Just digging into what we've been seeing a little bit. So taking a look at the S&P 500 over the past 3 days, because we've been seeing after that climb out of the bear market, at least according to some definitions, we have now been seeing a bit of a slide in the major averages. So now the S&P off by more than 1% over the past 3 days. Taking a check on some of the sectors that we are watching in today's session, specifically all 11 industry groups in the S&P 500 are in the red. We've got materials, real estate, communication services down the most. Nothing really tumbling, but everything just sort of feeling the downward pressure in a more general way. Taking a look at the Nasdaq 100, which we like to check at the open as well. And there we're seeing kind of a mixed picture, but more red than green on the screen. But again, no big moves, which is different than recent sessions, where even where you're not seeing a lot of movement on the surface of the major averages, you still are seeing some individual big moves here. And just to look at it on the equal weight basis here, Match.com down the most. I believe it got a downgrade today. It is off by 3.5%, but that's not a big move downward. Rivian up about 2%. So a little bit more muted in terms of the individual stock moves in today's session. Quick check on crypto as well, which I think we're going to talk about more later, but we're seeing some pretty sizable moves in crypto here today. As usual, not sure why, but we are seeing Bitcoin climb by about 8% today, and it's around 29,000 as we watch that. Also checking quickly on the semiconductors, which tend to be leading indicators, right? You're seeing some red there, but again, not huge moves. Diane?
All right. Now, with the possibility of future rate hikes and the looming threat of a possible recession, some are making the case for a less flashy, more consistent investment. Dare we even say boring? With more is Ann Berry, Threadneedle Strategies founder, who argues that boring is where it's at. All right. So, Ann, talk to us about some of your boring. I like one of them. I know what's coming, but take us through what you see as potentially boring.
I think let's define boring. Okay. Let's talk about what the dullness means. So I think large businesses at scale that have been around for a really long time, we know they're not going to disappear overnight, where they generate a lot of cash flow, which some people would call glamorous, but they aren't necessarily the big juggernaut, the big growth stories, the big AI stories. They're just there. They're not going away. There's probably pretty stable pricing. And often I like to think they've got dividends being yielded as well.
We like that.
Why boring, though, right now in particular?
I think, Julie, that we're at this really tricky moment in the markets where if you look at the S&P, if you look at the Nasdaq on a PE basis, it's very expensive relative to historicals. There's almost no presence of an equity risk premium. I don't like that. The other thing is, too, there is such an important moment. We're at an inflection point around technology, around AI. I do think we're in bubble territory because people are putting money to work without clear definitions and clear monetization paths. These are the moments where I want to hunker down in the boring, Diane, but I want to keep some money available to go into some of the more glamorous stuff too.
All right, well, let's talk about the boring picks that you like. So Walmart is one of them.
Yeah.
I like that one. Tell us why Walmart and name a couple other ones that you think.
So Walmart to me is boring in the sense, again, it's groceries, right? It's a low margin business, but it's the lead player. It's not going away. Everyday low prices, and particularly if there's a recessionary environment coming,
everyday low prices.
EDLP is going to come back in fashion, and we've seen this migration towards even higher income demographics. They're all looking for value, so that's where I think Walmart's important. However, it's got a cash dividend, which I like to have to reinvest back, and a little bit around the edges. It's boring with a little bit of sizzle coming around the edge. That company is collecting a ton of data. Over 100 million Americans touch Walmart in some way, the stores, the e-commerce platform. They are collecting that data. They're using it to sell sophisticated ad services, and they're using it for product development. So that's where it's boring, but perhaps it evolves into something more glamorous.
And you say it throws off a dividend. It's not a very big dividend.
It's not a big dividend.
It's like, what, 1.5% or so?
Small.
So obviously you're prioritizing some dividend, but not necessarily a big dividend, right? When you're
Exactly.
looking at these various companies.
Exactly.
Mike, let's see, Ford and GM.
Yeah.
You're also looking at those
Yeah.
as boring, especially, I guess, compared with Tesla.
Yeah, and we should definitely talk about Tesla. So Ford and GM, I have put my money in, and I have stayed out of Tesla, which is a move I will probably regret, particularly seeing what's going on with the charging network today. Ford and GM, it's a similar thesis. It's got a core business, which is not EV. That business is throwing off cash, and that cash is being reinvested into the sizzle, which is EV. Just like Walmart, taking that core cash, putting it into sort of data and e-commerce. So that's my auto thesis.
That makes sense.
We're going to come back to
Yeah,
Tesla.
all things Tesla.
Yes, we will.
All things Elon.
All right, and stick around. We're going to move on to some of the movers that we're watching here out of the open, and we'll get to Tesla in just a second. But first, Peloton. Shares are taking a hit this morning. Wolf Research downgraded the stock to underperform. Analyst Zach Morrissey there reportedly saying a path to growth for the fitness company doesn't seem to exist. He set a price target of $6. That would mean about a 27% drop from yesterday's close here. Last month, the company did launch a rebrand with a 3-tier subscription program that includes a free option, as the company really has pivoted, Diane, to like away from the equipment and really has tried to put the emphasis more on the service offering, on the classes.
Yes. And the app, I'm an app user, but I have noticed, I probably reflect the, larger group of people who has started to go away from using Peloton. I signed up for a gym membership again recently. I know a lot of other people have already done that, but look, we're looking at Peloton. Look at that, over 5 days, down 18%. But forget about that 18%. I mean, you're looking at 3 months, whether you're looking at year to date or from a year ago, they are far from their high-flying levels. And, once upon a time, they were a pandemic darling. They are just so far away from that.
Yeah, I argued for a long time that this was a fad.
You were right.
That, that it has been the rare exercise trend in history that has not been a fad, that has stuck around, especially one that's been attached to a specific company. And maybe that was the case here. I don't know.
So wait, you argued it was a fad?
Correct.
Right. Okay.
Because most exercise trends are fads, especially ones, again, that are put forth by individual companies. Like types of exercise, running, right? Yes. Like it's not attached to a specific company. That's around for a long time. But, Tybo or
I remember Tybo.
Oh my gosh.
Yes.
I don't know. And do you have a Peloton?
I do, and it's become this dust gathering sculpture that sits in the corner of my apartment. So I'm with
I've noticed that with a lot of people's Pelotons. I mean, when you're looking at like Facebook Marketplace, there's so many Pelotons on there right now.
That's not good news for the company.
No, not at all.
All right, as promised, Tesla. Let's talk about those shares. They're trading they were trading a little bit higher this morning, and they still are. They're up 0.8%. The stock's rally resuming here. CEO Elon Musk announcing the EV company will head to India as soon as humanly possible. Last month, Musk floated India as a possible location for a new Tesla factory, but efforts to expand in the country have been slow because of efforts to negotiate lower import duties. Of course, it's been a big year so far for the stock. The company announced this month it would open its supercharger network to GM, Ford, and Rivian. And the company's market cap is on the rise again, racing toward the $1 trillion level. Some analysts, though, are not convinced. Barclays has downgraded Tesla this morning, saying the stock has rallied too high and too fast. Ann Berry is still with us, founder of Threadneedle Strategies. She joins us now. And you just said you like Ford and GM over Tesla, although you may regret that decision. Yes. I've been trying to figure out during this current rally, like what they actually get out of having these other companies participate in the supercharger network. And I haven't been able to we don't know what the financial arrangement is.
Right.
Because the companies haven't disclosed it.
Right.
And so more cars backing up at Tesla charging stations. I don't know.
I mean, it does feel like, though, Ford GM could be if you can't beat them, join them kind of play.
Yeah.
What are your thoughts on that?
I think that's right. And so I have a hypothesis, Julie, to your point. This is not based on fact. This is pure speculation. And this is where I think Elon Musk has proven himself to be a chess master over time. He takes a very long-term view. You just said it, Julie. All these cars backing up at a Tesla charging point, which means Tesla is now going to sit there above the fray, gathering data, the most data in the United States on where EVs are charging, when, with what frequency, by model of car. So I think this is a data play. Pure speculation, but that's my guess.
But then what do you do with it? I don't know. And it's interesting that he's seen as a chess master, because I also feel like half the time he's just like,
seeing what sticks, spaghetti on the wall.
Yeah.
I think he does some of that.
Maybe a little bit of both.
Yes. I mean, especially like we saw that with Twitter. But sticking with Tesla, I mean, look, it's definitely working, creating these relationships, these joint ventures with, say, Ford, GM, and now Rivian joining them, because Rivian was seen as a potential eventual contender to them.
Yeah.
Obviously not at the same
point.
level,
Yeah.
but them now joining up with Tesla, that was the only one I was originally, Ford I was originally surprised by. Then GM came, I'm like, okay, strange bedfellows. But now everyone in Tesla becoming kind of the industry standard, especially when it comes to the charging network. So I think, to your point, I do think Elon is playing the long game here. But one quick question on Tesla: do you see it as an AI company now? Some people say that that's what it is now.
I see it as a data gathering company which feeds into AI in some capacity. And I think, Julie raised the question, get the data to what end? Well, imagine now they can see what the battery life is with real specificity for all their competitors. Can they start having a selling point, which is with a battery that outlasts by literally X% relative to our comp? So I don't know. Again, it's just speculation. But I do think the winners in AI are the winners in gathering huge amounts of clean, usable data. And I think any company that takes moves to that, even in the equipment space, is going to have more opportunity on the services side down the line.
And we did speak to an analyst recently who also said that the superchargers are the way to sort of the gateway drug, for lack of a better word. That's my word, not his. For the software, for Tesla software.
Yes.
So why aren't you buying Tesla? Why, and you said you might regret it, but why is it not attractive enough to buy right now?
Well, I've missed the boat on this. The reason I've gone to Ford and GM in the past is because they had cash, they had core businesses, and they had a clear plan against which to execute. I have been avoiding, frankly, the big vision lack of specificity stocks because a lot of those stocks got burnt in 2021. Tesla, I think, is maybe proving to be a little bit different. It's very hard to value it based on, just the dream. But Elon Musk seems to be executing. The person who I do follow, actually, is Dan Ives at Wedbush. Yeah, you both know him.
Friend of show.
Friend of show. And he has started to get even louder on some of the platforms saying, look, this isn't the moment to be eyes down in your spreadsheets to try and figure out your valuation. This is a moment where you're looking at AI and saying, actually, who's got the vision and who's going to win at scale? And I'm starting to get a little bit of the Dan Ives religion on this, just a little bit.
We shall see. All right, and stick around. We're going to move to another mover, and that is Winnebago. Shares trending down by almost 3% after reported revenue fell short of expectations. The drop in revenue across both its towable RV and motorhome divisions was attributed to lower unit sales and higher discounts. And this was Winnebago is always interesting to me. Any of the leisure vehicle category is always interesting to me, right? Because on the one hand, you have people who are traveling once again. On the other hand, they're buying fewer things and especially fewer big ticket items. And so I guess, you did have a bit of an RV boom during the pandemic.
Exactly. That's what I was going to say. This is another pandemic pullback.
Yeah.
I mean, so, you saw a lot of these on the road, or more than we had seen in decades. Because once upon a time, that's what Americans did. And then they returned to that during the pandemic, but now it's certainly a pandemic pullback. So not surprised to see that in terms of their numbers today and the disappointment there. They're trying to spin it, saying, our team continues to successfully navigate a dynamic environment. The dynamic means it's changed.
Right, and it's changed for the worse in their case. Right. I mean, towable RV sales in particular were down by 52%. And again, that was because they sold fewer of them. We talk a lot about the price volume balance, but here there is just a clear decline in volume that cannot be made up for with an increase in price. And Thor Industries, which is another maker. By the way, Winnebago does make some marine vehicles or marine, I guess.
I don't know the name for it, but yes.
And that segment did do a little, it's much smaller, but that segment did not fare as poorly. You can see up about 1.9% year over year, but again, that's about less than a third the size.
But the Winnebago stock not taking as big of a hit as he did in the pre-market, so down just a couple percent or 2%.
I haven't had a chance to look at the conference call, so maybe that's something that they said on the call.
Yes, maybe something they said on the call helped kind of reverse some of the pullback that we were seeing in the pre-market action. And also maybe some of the action now muted as we wait for Federal Reserve Chair Jerome Powell to begin his official testimony. We have the prepared remarks out, obviously.
Yes.
Indeed.
All right.
Coming up, companies are trying to ride the AI hype train, but in the long term, which companies will emerge as winners? We are going to take a closer look at that. Stay with us. Will it or won't it? A much discussed recession still has yet to appear this year. Some on Wall Street remaining cautious of the year's market, while few are optimistic the worst is behind us. The VIX, the so-called fear gauge, a popular measure of the stock market's expectation of volatility, has priced out the recession risk. With more, we are joined by Yahoo Finance's Jared Blickery, who joins us now. He's getting set up right now. All right, we're getting him set up, getting locked and loaded for Professor Jared. All right, Jared, let's talk about the VIX today. What do we got?
All right, let's talk about the VIX, and I'm going to bring along my helping hand here, the Wi-Fi Interactive, where I'm looking at a post. This was on the market here. The source is the JPM FX team. They're saying the VIX has priced out U.S. recession risk, dragging FX volatility, that's foreign exchange volatility with it, that would be down, and driving safe haven dollar outflows. So here's the VIX in white, and this goes back to December of 2020. So it leaves out the worst of the pandemic, but you can see very closely correlated with this blue line that I'm just not very well tracing it here. The point is that both of those are coming down heavily, and I don't know that you want to price in recession risk with the stock market, probably go in terms of the bond market, but anywhere you look in this market, I'm going to go down. Let's take a look at the bond market. Here's the ICE B of A move index, kind of like the VIX of the bond market here. Here's a 3-month chart, and you can see over the last 2 days, we have broken to new lows that we haven't seen this year yet. And here's a 3-year view where you can see we are coming back to the 100 level. That's That's a big psychological number. I would expect to see maybe a pause or a bounce there, but volatility heading in the right direction to support all of this risk on talk. And then here's another look at the VIX. You can see right now we are at multi-year lows, and this is really starting to feel like the regime that we had before the pandemic. Also in late 2021, I don't know that it feels the same as that, but definitely in the late 2019 era. So a lot of things have changed over the last week. I do have some other notes. Besides effects volatility, some other things have been changing within the market. Let me just pull up this note that I have right here. I believe this is from Goldman. And indeed, here's a put call skew shows that single stocks and index investors are positioned for upside. There's a key line in this report. The skew measures indexes, very much out of the money call and put. So basically those long shot bets, these are cratering, showing more interest in those bets. Key line here is index put selling and call buying jumped on June 2nd. What was happening on June 2nd? Well, that was the day of non-farm payrolls, and that was a very pivotal day. That's when we saw this first rush into the value cyclical sectors that we've seen largely sustained since then. So I think that was a real game changer. And I just kind of happened to land here on the Wi-Fi Interactive on a 1-month view of the S&P 500 sector list. And you can see it's a healthy mix at the top of consumer discretionary, that's retail, XLY, followed by XLK, that's tech, and XLI, that's industrials. All of these have been expanding the breadth of the rally, but it does remain for many a show me rally because we still got the Treasury looking to refill its coffers to the tune of $1.5 trillion. That's a lot of money to be sucked out of the market this year.
Yes, indeed it is. But it is interesting to see the cyclicals lead that rally over the past month. Thanks so much, Jared. Appreciate it.
You bet.
Well, what else has dominated the market rally? Of course, it's AI hype. It's dominated earnings calls as well and market enthusiasm for much of 2023. Although everyone seems eager to benefit from soaring AI interest, which companies will actually win out in the years to come? Ann Berry, Threadneedle Strategies founder, is joining us now. And Ann, you gave us a little taste of this in our earlier discussions. It has to do with data.
Yeah.
Data. I say it differently all the time.
I say I never know what is the right way to say it.
Yes, but it has to do with that. So how does then that thesis play out?
Well, let's start with a piece of equipment that we all know and love, right, which is the iPhone. And so we all have it, right? It's out here. And the narrative around Apple is it's becoming an AI company because there are so many Apple devices out there gathering consumer data all the time, 24/7. Is that going to be the data gatherer that wins in the consumer space? So, Julie, I look at that and I say, I think that's an interesting thesis. Now, who is the equipment manufacturer and data gatherer for other sectors that we don't talk about as much? In farming and ag, for example, I think it's John Deere. In medical devices, I think it's Medtronic. So I'm trying to take that Apple thesis in AI and apply it to other industries to look for places to play without these massive valuations.
Well, speaking of Apple, I mean, look, it's up huge. It's not the most compared to the rest of the Magnificent Seven, if you will, this year. I mean, it's up 47% year to date.
Yeah.
Is it too expensive at this level, or is it because it could be seen as, as an AI leader? Does it have more room to run?
I'm not buying more Apple at right this moment. I have been buying Apple up until now. I do think there's a replacement cycle coming because lots of folks are due for upgrades. And I do think that there is some AI sitting in there. I think where I'm a little bit nervous about Apple is it has been right in the eye of regulators trying to figure out how privacy and data is conserved. And I think until that's sorted out for Apple specifically, it's going to have perhaps a little bit too much scrutiny. I think there are others who are sort of flying below the radar screen.
It's so interesting to be the AI discussion because all of these companies have already done this, right? In other words, Deere already has a lot of data, Medtronic already has a lot of data, and they have been using it through machine learning and AI, which has been around for a while. I'm really curious, and I know we're not data scientists sitting around this table, but how generative AI then pushes it that next phase of growth for some of these companies.
Well, I think that points, Julie, to there is going to be a replacement cycle. There is going to be a next generation of hardware and equipment that's able to process data more quickly, that's able to collect more sophisticated data. Sensors, for example, are getting more sophisticated. So I think there's a whole generational upgrade of the equipment provided, a replacement of the installed base that's going to come. But I think, Julie, the other piece of this that's interesting is on-site data scanning. right? Getting real-time insights. Let's take medical devices, for example. One of the applications of AI that Google's talked about is much more sophisticated reading of scans, of x-rays, even beyond sometimes what medical practitioners can do. But you've got to have the equipment that's actually doing that in the clinic or in the room with you. So I think that's where that cycle is coming from.
Speaking of Google and something that you mentioned earlier about privacy concerns when it comes to Apple, and you talk about them being under scrutiny. I mean, Google, Alphabet has been under scrutiny, particularly when it comes to Europe. Is there any cause for concern about where it stands in terms of its value for Alphabet?
I think so. And I think this also comes back, Diane, to the bigger question, which is how is AI going to be regulated, period? Right? That's so up for debate right now. We're seeing the talks that are happening in the UK. Right. The EU's actually been quietly in the US, not so quietly if you read the European press, passing regulations and laws designed to limit it. In the US, we don't actually know what the AI regulatory framework looks like yet. And until we do, it's really hard to know whether it's going to cap the growth of the big tech companies specifically.
Yeah. We'll have to see what happens. Anne, thanks for spending so much time with us this morning. This was fun.
Yeah.
Anne Barry, Threadneedle Strategies founder. Appreciate it. Well, we got some other great interviews on tap today. Our 3 to 5 anchor, Shauna Smith, is going to be live all day at KPMG's Women's Leadership Summit, bringing us interviews with former U.S. Secretary of State Condoleezza Rice and LPGA player Stacey Lewis. You don't want to miss those. Plus, that's not all. Jennifer Schonberger is going to be bringing us an exclusive interview with Atlanta Fed President Raphael Bostic. That's coming at 3 p.m. Eastern. Don't want to miss that either.
Coming up, as investors look ahead to the Fed's July meeting, why our next guest says to expect rate cuts despite a looming potential recession. We'll discuss. That's next.
Welcome back. It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That's Diane King Hall. Brad Smith is on assignment, and we're just a little more than 30 minutes into the trading session. Let's take a look at some top movers right now. FedEx not delivering the goods, the economic bellwether in the red after missing the street with its outlook as weakening demand bites. Fourth quarter sales came in at $21.9 billion. That's down 10%, and it's a third consecutive decline. Analysts are not all turning bearish, however. Citi and Raymond James both holding their buy rating on the stock, and Scott Schneeberger of Oppenheimer, who we spoke to earlier, he's still a perform. He's still waiting for a little more evidence of a turnaround at the company.
Meantime, Intel shares falling after the company agrees to sell a minority stake in its IMS nanofabrication business to Bain Capital. The transaction values the unit at about $4.3 billion and is expected to close in the third quarter. Intel said the move will push for innovation of critical tools needed for EV technology, excuse me.
And Patterson Company stock soaring after the company exceeded expectations for the fiscal fourth quarter. What is Patterson, you ask? Well, it makes dental and animal health products. The company reporting 85 cents a share from the projected 70 cents a share, so beating estimates there. And the company's outlook also topping expectations. Interesting here, some of the analyst commentary around Patterson. Jeff Johnson of Baird reportedly neutral on the stock and saying that the company specifically is executing well, but it's not clear that the macro environment has improved to enough of a degree for him to up his rating on the stock, Diane.
All right. Well, Federal Reserve Chair Jerome Powell's semi-annual testimony on the Hill is starting now. He said in prepared remarks that nearly all FOMC participants expect to raise rates later this year. The hawkish sentiment continues in light of the outlook for a recession by year end. Investors see a near 80% chance of a quarter-point hike at the Fed's July meeting, while economists and investors are focusing on a potential looming recession. Our next guest says we should be addressing the growth slowdown instead. Joining Yahoo Finance's Francis Donald Manulife, investment management chief economist and strategist, to discuss the case for a recession, what it means for investing in risk assets. So is a potential recession still in the cards for 2023?
We have very high odds of a recession in our forecast, and that's because every single leading indicator that has traditionally told us a recession is coming is flashing red, deeply red. And even when I say to the team, hey, maybe you could have that because there's elements of this cycle that are different, it still tells us that a recession is ahead. The challenge is this recession may look different in some ways. So, for example, we're still in a massive labor shortage. So we know the unemployment rate's probably going to climb a little bit less than it has historically. But the big thing is how are central bankers going to respond to it? Because when we first started talking about recessions, we assumed the Federal Reserve will cut. That should be good for risk assets. We can push cash aside and then, slowly start adding. But now we have central banks, and this is a game changer, who are saying, you know what? We know there's a recession. We forecast a recession, but we're still not going to cut. Very different playbook than what we've seen in all of the modern economic recessions. And I'm not sure the market's really caught on to that big differentiator just yet.
Well, how unusual is it for there to be a recession that doesn't bring down inflation, right? And that's obviously what, other central banks around the world and the Fed are focused on.
That's right. That's that stagflation word. And what do central bankers do with that? Now, if you extrapolate further, so, we got to talk about the next year, but as long-term investors, we're also thinking out over the next 5 to 10 years, what are central bankers going to do when we're in this new environment where inflation is being driven, not entirely, but more by supply side and global factors? What if we get stuck between 2 and 3%, which is actually our forecast for long-run inflation? Central bankers are either going to say, that's not good enough, and I think that results in rolling recessions or rolling weak growth, or we're going to have a big moment where we say the central bank focus on 2%, it has to change. That is very different than any economics textbook I ever read, and it means that we have to think differently about long-term investing in that sort of environment.
I don't think they're going to change. I mean, that 2% target has been around longer than probably, we can remember. So I mean, yes, there has been talk about the potentially changing that target, but given that that's not likely, and the Fed is hyper-focused on that. What is your expectation in terms of what the rate outlook will look for the rest of the year?
Well, central banks may not say the end of 2% because that would de-anchor inflation expectations. But even before COVID, you might remember the Fed was talking about flexible average inflation targeting, which effectively says we're going to take the past into consideration. Now, historically, that meant, we're going to let inflation run to the upside. We've just been through the largest price shock of many people's lives. And even though we're going to have inflation maybe come down to 2 to 3%, we're not going to go backwards. We're not going to pay what we were paying for things in 2019. So that psychology probably means that central bankers aren't just going to be okay with 2 to 3%. They may want to go below. Now, in terms of our rate forecast, we're talking about the July hike. We've put it in, we've penciled it in, but most of our asset allocation decisions don't depend on July hike or no hike, or even September hike or no hike. They depend on 2024. Does the central bank respond to the recession by cutting? We expect that they'll go with normalize, maybe cut down towards that neutral rate, whatever neutral rate is, but refuse to go into easing territory. So some cyclical moves in rates, but not what we're used to historically.
Now, Jay Powell right now is sitting in front of the House Financial Services Committee giving his opening statement, but he's going to get some questions in a little bit. And I suspect that at least some of those members of Congress are going to say, why are you still contemplating hiking when we're staring down the barrel of a recession? I mean, what's the response to that?
The response will be...
And do you think that's the right question to ask?
It is the right question to ask. Now, we're only beginning to see the side of unemployment, right? Jobless claims are just starting to crawl upwards. Weekly hours worked, which, by the way, will be the better metric of how much labor demand there is in the system, is back to pre-COVID levels. This question is going to become more and more or louder as we start to see those non-farm payroll numbers drop, when we start to see real people losing their jobs over time. What we're going to hear from central bankers is, well, it's better to have short-term, they'll call it, labor market easing. Labor market easing means people have to lose their job to bring the inflation target down. So they're going to have to talk about that. The political pressure on them is going to rise as those unemployment numbers get higher. But more importantly, I think we're going to hear, is that the right cost? Should we really be penalizing Americans with job losses to cover this COVID-related inflation, which is largely driven by things that are not domestic and not demand focused? So political pressure on the Fed.
Aren't they now, though? I mean, the causes of inflation have shifted considerably after the pandemic.
Yep, that's true.
Yeah.
And
Some of it's just because inflation.
Yeah, exactly.
Inflation feeds it. Yes.
But let's look at that mix of inflation, and not just on a month-to-month basis, but think about used cars, for example. Used cars are still producing massive volatility in the inflation framework. Is that because everyone's buying too many used cars and that we're all paid too much? Or is it because we still have fluctuations? The central bank's not just looking at year over year, they're looking at that level. And that level is being driven by things like conflict. There's still a war happening between Ukraine. There's still geopolitical tensions. My newsfeed all today is talking about U.S.-China geopolitical risks. We're still talking about massive climate impact, so frequency and severity of weather. We were just talking earlier about all the wildfires in Canada. This is still impacting inflation in an important way. And going forward, not on the month-to-month, but on the year-to-year, we are going to see that share of non-demand, non-interest rate inflation grow relative to where we've been in the last 15 years.
I want to go back to your point about the job market. We've continued to see these jobs reports that are much better than any economist predicts. Could we really see that, the upward movement? I mean, yes, we're seeing some change in terms of the weekly jobless claims, but the monthly payrolls report, the NFP print, has continued to be better than expected, month after month after month.
Yes.
I mean, it's showing to be a really resilient job market. And especially you think about, I just want to give a little bit more context here. Like when you go back to the dot-com boom, that helped the job market. This AI generative phase we're in, we are still in the early phase. That could very much be seen as accretive to the job market. What's your view on the potential for the job market to remain resilient?
So let's start with the textbook answer to that. The textbook answer would say the job market is always the last indicator to go. The job market tends to weaken only once you're in the recession, and it doesn't go slowly. It goes all at once. It's very nonlinear. So even in a standard recession, we're not seeing something that's inconsistent with a recession ahead. However, let's add in the post-COVID layer. This is a massive labor shortage. Why? 40% of Americans don't work, are not looking for a job. The employment to population ratio in the US is at 60%. We are still seeing sub-labor force participation rate. And what companies are saying is, we're going to try to cut costs in this recession in different ways. And this is why the unemployment rate, I don't think, is going to be a valuable indicator. And it's not going to reflect how Americans feel either, because the hours that they're being asked to work are declining. So they may have a job, but are they making as much? No. Are they working as much? No. We have to really broaden our understanding of what a healthy labor market is. It's not going to be, do you have a job or not? A lot of Americans will, but they're still going to feel recessionary.
And I want to come back to one thing that you said, where you said, if we have these rolling recessions, if the Fed is going to keep that 2% target, you have to think about investing differently.
Yep.
So just as briefly as you can, what does that mean?
Well, it means that these returns that we've seen in a standard 60-40, they're probably going to be lower than they've been historically. We also need to realize that that stock bond correlation is probably going to go positive more often, which is painful if you're only in equities and fixed. Got to start thinking outside the box, adding real, adding alternatives, adding private assets. You need things that are less sensitive to the economic cycle and less sensitive to inflation. That 60-40 is not going to hold you in the way forward if this is the economic environment we're heading to next.
We'll see. Thank you so much, Francis. Really
Thanks for having
interesting
me.
stuff.
Great
Francis
stuff.
Donnell is Manulife Investment Management Chief Economist and Strategist. Coming up, we're going to head back to France and share Brian and Brad's interview with an executive from PepsiCo. You don't want to miss that.
Brad Smith here with Brian Sazi. You're watching Yahoo Finance, and we are here at Cannes Lions Festival of Creativity. Joining us now, we've got Jane Weekly, who is the Chief Consumer Marketing Officer and Chief Growth Officer of International Foods at the great brand of PepsiCo. Thank you so much for joining us today.
It is the longest title in history.
But it's a great one.
I'd
wear
like
many
to
hats.
rebrand it. You know, Chief Smiles Officer.
Well,
Let's leave
you're
it at
in
that.
charge of marketing.
Let's leave
You
it
could
at
do that. You could rebrand your
You know
title.
what? I'm working on it. I'm working on it.
Well, you're bringing a lot of people smiles already through both beverage and snack, but now you're going to bring even more people smiles through soccer, or should we say football?
Oh, nice. You've been doing your homework. Did you like that spot?
I did.
Soccer versus football? Okay, yeah, no, we've got some very exciting news to break here at Cannes. We're actually announcing that we've just signed again with UEFA Champions League for the next 3 years.
Wow.
For both beverages and our foods business, which we're incredibly excited about. And actually, I was at the final in Istanbul 2 weekends ago. And, you know, the energy and the difference we can make for our brands, for our consumers who we serve, but also for people and planet through this partnership, we're super excited about. So, like at Istanbul, I attended the Gatorade 5v5 contest as just one example. Mm-hmm. And, you know, we've now touched 120,000 young people's lives through that. And it's all about driving access to sport in line with Gatorade's mission to fuel everybody. And just seeing the impact that sort of initiative has on young people's lives. We're very excited to be able to do things even bigger, even bolder in the next 3 years. Wembley next year. See you there.
Yes.
Well, how will you show up? How will your campaigns look different over the next 3 years?
Well, you know, you can already see we're very intentional about driving diversity, equity, and inclusion in sport. So just as one example, you know, this year we really used our brands and their reach and impact to elevate female access to sport and the female game. So, for example, in all of our big campaigns on Pepsi and Lay's, we featured both the male stars and the female stars. So on billions of packs around the world, you not only saw Messi, but you know you also saw Lika Martins. In our campaigns, you saw Lika Martins, Thierry Henry on Lay's, Leia and Vinny on Pepsi, and you know it's really important that we believe if you can see her, you can be her.
About time, Jane. I'll just say it. About time.
Thank you.
Good
Thank
stuff.
you. Yeah, so we're really excited about that, and we've got big plans for Wembley. So book your tickets now.
Done. You heard it here first.
And it's the first time the female game, the female final ever sold out, record-breaking attendance. And so, you know, I'd really encourage you, book your ticket for both now.
That is going to be my next concur charge the second we get back to the office, Jane.
Nice.
You authorized it.
Yeah, absolutely.
So as we think about what you're seeing in the customer right now, how would you define this customer across the categories that you're looking across at PepsiCo? Because we've continued to hear that the customer's resilient in their spending, the customer's healthy. How do you see them from your perspective and the executive teams?
You mean what we define as consumer, I think, like so the people we ultimately serve. So look, our brands really democratize pleasure, democratize joy, democratize better for you approach to both snacking and beverages. And so our brands have very high reach. So, you know, our penetration from a portfolio perspective is over 90% of all households in many markets. And therefore, you know, we need to really be close to the people we serve and their needs. And what I'd say is we're lucky to be in categories that are very resilient. You know, people are still enjoying the beverage, enjoying a snack. And, you know, we're leaning into that, but we're also leaning into the differences in the consumer's needs. So we're providing choice. So, for example, we're increasingly dialing up our offering of zero products on the beverage side. We're ensuring that consumers have a choice and can really opt into whichever part of our brand suits them best. And so that type of offering is really important to us. And on the snack side, you know, we're working hard to reduce sodium, reduce sat fat, for example, to ensure that, you know, actually when you enjoy a bag of chips, you're enjoying it in the very best way you can. And, you know, removing those slight niggles which might hold you back so that you can really enjoy more often.
For the past 4+ years, after every earnings call, we have talked to your longtime CFO and Vice Chairman Hugh Johnston, and he has told us repeatedly, snacks are on fire. They're hot. Everybody likes snacks. Everybody's snacking. So I'll put this to you. What is the secret ingredient behind keeping snacks hot, Because when I walk down an aisle, Walmart, Target, Kroger, Albertsons, you name it, this is a competitive section. How are you giving a guy like Hugh these results every single quarter?
Well, it's putting humans and people at the heart of our business, both in terms of who we serve, the consumers, but also, I believe, the people that work at PepsiCo. You know, ultimately, we are there to serve our consumers, and we're working hard to delight them with the product quality, delight them with the entertainment, and be highly visible and meet their needs, right? We're moving with the times in terms of how we reach them, in terms of the portfolio we're offering, and that's keeping us highly relevant. So yeah, snacks are on fire, that's for sure.
And what about in the messaging? Because for some brands, they've gotten it incorrect by wavering on their messaging that they're hearing their internal constituents want the brand to stand for and represent, and their external customers and partners that they also want to hear them take a stance on. How do you approach that at a very polarizing time like this?
Look, we're true to, firstly, I think it's really important that at PepsiCo, we're very true to who we are. We have, you know, one of the reasons I joined the company was the company and everyone that works at it has deeply held values. And we, you know, really strive to be very consistent with those values, whether it's an internal people decision or brand decision. And as far as our brands are concerned, I think it's important to find the authentic sweet spot between what your brand means to the consumers you serve and the impact that it can potentially have on the world. And that has to be authentic. You have to walk the talk, to really have actions behind what you say. And I think, you know, if you know, we certainly strive to follow that guidance, and that's the sort of guardrails we use internally on how to navigate. But yeah.
You've mentioned, just going back to something you mentioned earlier, Jane, on Gatorade. Gatorade has long been the standard bearer in that sports drink industry. It's a brand we've all grown up with, but there's been a lot of new entrants in this space. Body Armor, you name it. And they've taken some market share. Is it time to change the messaging for that brand? Or, I mean, how do you take into the next generation to take the fight back to some of these other smaller brands?
Yeah, look, Gatorade's one of our fastest growing parts of our portfolio. And ultimately, you know, we're going to stay distinctive to who we are and really focus on category growth as our primary driver, as well as being competitive in the market. And the way you do that, I believe, is you double down on your strengths. So, you know, Gatorade stands for hydration, obviously, and fueling access to sports. And what we're doing is we're really trying to deepen our impact by creating more choice. So you've seen innovation on Gatorade recently. Gatorade Light, obviously. We're innovating into new formats, such as reusable cups, powders, pods, you know, driving new occasions to drive plastics out and really trying to innovate into spaces that actually our consumers really are asking for. We're leading and shaping the category by meeting our consumers' needs every day. And that's what we're focused on.
We only have 15 seconds, but can generative AI tell you what the next great flavor of Gatorade might be?
It's always blue. It's always blue.
Always.
Or is it red? No, it's blue.
I would predict that generative AI would say it's delicious. I'll leave it at that.
Jane,
that's blue.
With the mic drop moment, Jane Wakely, Chief Consumer Marketing Officer and Chief Growth Officer of International Foods, joining us here. Excellent. We'll toss things back over to you.
That was Yahoo Finance's Brad Smith and Brian Sozzi. Stay tuned for much more of their coverage from Cannes. Now to a story that has captured global attention over the last 24 hours. The search has escalated for the missing OceanGate submarine holding 5 aboard. It was last detected near the Titanic wreckage on June 19th, and there are now a number of different craft, ships, as well as an undersea robot that have been deployed to try to locate that submersible. Yahoo Finance's Pras Subramanian joins us now with some background on this story. Pras.
Yeah, like so you mentioned that submersible was deployed on the 19th Sunday to go down to 13,000 feet below the sea to go check out the Titanic and view it in that really kind of the carbon fiber and titanium sort of constructed submersible. A little less than 2 hours into the actual journey, it lost contact with its trailing boat, and that's when the search began. Some good news recently, they've heard some banging noises every 30 minutes. They're not sure what it is. Their sonar buoys picked it up. They think it might be the actual occupants banging every 30 minutes in the submersible. They're not sure, but they're going to deploy. Like I said, there's a robot down there. There's another couple deployables down there to check it out. So possibly going to evaluate and track down where that is, but they still don't know where it is at the moment. Time is of the essence. The ship had the submersible had about 96 hours of oxygen. They think there's about 24 hours left, give or take, on that submersible. So it's really a make or break situation right now for this team looking for the submersible.
And this was a costly endeavor for all the participants, right? I mean, this was supposed to be a fun trip, if you will, and this turned definitely very serious. In terms of the cost factor, we were talking about this earlier. Julie mentioned this about the potential for legal action here. I know that's far out. What is it? I mean, for the timeline, how much longer do we have?
About a Thursday afternoon, I think. Thursday sometime.
Okay. And then what are we hearing in terms of OceanGate, the company, the people behind it? There's a lot of facts coming out recently that, talking about this company founded in 2009, based in Everett, Washington. Like you said, $250,000 excursion for an 8-day trip out to the Titanic. Last night there was I think it was ProPublica released a report about how there was a lawsuit with a former employee talking about how the ship was not safe and that the OceanGate was still pushing through with these journeys. So there's some kind of question as to how aggressive they were with pursuing this extreme travel type of trend that's been recently been big, as we've seen with space and things like that. So I mean, it's hard to say what's going on here exactly. I can't speak to whether it's a defect in the actual submersible, but it's definitely a risky endeavor for these people.
Well, and you touched on this sort of wave of extreme, not only extreme travel, but extremely high-end travel, whether we're talking about people going undersea or up in space. So you have to wonder if a situation like this, which is unfolding in very public view, will have a dampening effect, even on something like a Virgin Galactic or Blue Origin, et cetera, even though it's a different realm that you're going into, whether that's going to affect those areas.
Well, I think it's a very apt comparison. I think when you consider deep space and also deep underwater, it's extremely dangerous, but also just extreme environments that the actual danger is very palpable. That when you're out there, there's no way to get out of these things, whether it's a submersible or a ship that glides across lower orbit. So I think that's very apt, and we are definitely, the investment community is definitely investing in these companies, Virgin Galactic in particular. And I think there's and I don't want to be crass, but there's definitely the opportunity for potential pain from an investment point of view if something goes wrong with one of these companies that are public.
And we saw that with Virgin.
And it's very, very apparent that this can happen to anyone.
For what it's worth, Virgin Galactic shares are down about 8% in today's session. Remember, they had recently gotten a leg up because they had confirmed that first commercial space flight.
Yeah, but indeed, this is a very sad situation with regard to the submarine. Hopefully, I mean, there is still time. So our prayers certainly with the individuals who are on board. Right. Supermanian, thank you so much. Switching gears, coming up, Kava broke the IPO drought. Is it a sign of more to come? We'll discuss. That is next.
I'm Shauna Smith here at KPMG Women's Leadership Summit at Baltusrol Golf Club, home of this year's 2023 KPMG Women's PGA Championship. Well, the event that's taking place, bringing together the top female leaders across industry, sports, business, politics, to discuss some of the major issues that is affecting women today. So let's talk a lot about it and focus on what's happening in sports. For that, I want to bring in Stacey Lewis, joining me now here, LPGA player, also two-time major champion, and you're also the captain for this year and next year of the U.S. Solheim team captain here. Stacey, it's great to see you. Yes. Thanks so much for taking the time.
Yes, thank you. Thanks for having me on.
So lots to get into today here, but let's first start with the big news when it comes to golf, and that, of course, is the tie-up between PGA Tour and Live Golf. There has certainly been a lot of pushback from the PGA Tour players, many of them saying that they have felt betrayed, upset about the agreement. I'm curious how you view this as an LPGA player and what you've heard from some of your colleagues.
You know, I think as a tour, we were as shocked by everybody else, you know, and I think the good part is that we are completely separate organizations, but, you know, we're all watching. We're watching what happens, you know, if this deal ends up going through. What does it mean for the PGA Tour? What does it mean for us? You know, I think there's so many unknowns right now. It was definitely shocking, though, to see the way the players were so surprised by this, and a great learning opportunity for us as a tour to make sure our players stay engaged in what's going on with our tour insides.
Do you see it reshaping the game of golf?
I think it already has, you know, has just with the Live Tours, you know, it's created some competition, which, you know, I think competition is good. It's what makes tours better. You know, I think you can maybe get a little comfortable, get a little stale at times. And so it's created some competition. And now can we figure this out and can we work together?
The LPGA Tour, as of right now, has been left out of the deal here. But if Live Golf, if they did show interest in the women's tour, would that be something that you would potentially be supportive of?
That's a tough one, right? I think, you know, we all have our morals and our values of where that money is coming from. And we got to figure out as a tour, does it make sense to, you know, is it going backwards doing that? You know, you look at our history, especially players in the early days of, you know, African Americans having access to these golf courses, and our players said, you know what, we're not going to play unless we're all allowed to play, and that's what our tour has stood on for so long. So it's going to be a decision we make as a tour, and you know, I think we all have our personal opinions on what that means, but I'm open to competition. I'm open to evolving and continuing to get better. You know, we can't just sit here and stay where we are. You know, we got to keep getting better.
And Stacey, talking about equality here moving forward, and with the fact that the Women's Leadership Summit is happening today, there's a big focus on pay inequality and what that looks like in the game of golf. And just to put it in perspective for everybody out there, the women's total prize purse is around $100 million for this year. Comparing this to what the men's is, which is right around $450 million.
Yeah.
What do we need to do, the steps that are necessary in order to close that pay gap, and how encouraged and confident are you that we're going to get there one day?
Yeah, I think you look at what's happened over with men's golf the last year or so. The biggest disappointment for us has been how substantially their purses have increased. You know, we were getting closer, we were narrowing that gap, and now that gap has just jumped substantially again. So, you know, I think for us, we got to focus on what we are doing. I mean, we're up. I think to 10 years ago, I think we were at about 30 to 35 million in our total purses. So, I mean, we're doing a tremendous job, but it's getting people to watch. It's you guys being here to follow us, to track us, to playing on great golf courses like this. You get companies like KPMG that, you know, they see the value in supporting women and how it can translate from the golf course to inside their company to inside their industry. And, you know, a lot of times it takes one company and one person stepping up and say, I want to change this. I want to help narrow this gap. And it's going to take time, but, you know, we're making great strides. I think of a Baltusrol, a place like this, you know, 5 or 6 years ago, they wouldn't even taken a phone call to have this championship. So we're moving in the right direction.
What are you hearing from brands, from sponsorships in terms of their interest? Sounds like you are generating a lot more interest, but how do you keep that momentum going? And what do you hope that landscape looks like 5 years from now?
Yeah, I tell you, our tour, we're having to hire more people in our sales kind of department because so many phone calls are coming in right now. probably more than ever so in our history, because people want to be a part of what we're doing. They want to, empower the women in their organization and show them that, hey, we're a part of the change here. And, we're on network TV this week, and that's a big part for us going forward is, can we be on TV more often and easier and more, you turn on PGA, you turn on the golf channel, you're going to find the guys playing, right? But you don't always know when we're playing. So we got to be more accessible to our fans as far as the coverage and things like that. So we got a lot of things to do, but it takes investments. It takes companies coming in and supporting us to make that happen.
Well, Stacey, you're a trailblazer, a leader when it comes to the golf world and what you have done. I know one of your priorities has been maternity clauses and what players need to do, what players need to have in their contracts. You were, I believe, the first, if not one of the first golfers here, players to get paid full 100% of your contract from your sponsor, KPMG, while you were on maternity leave. Talk to us just about what needs to happen, the necessary steps that need to, I guess, be taken at this point in order to ensure that every player gets that 100% pay.
Yeah, so probably a lot of people don't know is, you see these logos on me, and I still have to play tournaments to get that money. It's not like, here's your check when you start the year. So a lot of them have minimums, and say it's just a round number 10 tournaments. If I only play 5, I only get 50% of the money. And so you get pregnant and say you can only play till March. Well, you've only played maybe 2 or 3 events. So you're getting a very small portion of that money. And, I was honestly terrified to tell my sponsors that I was pregnant. They've invested a lot of money in me, and how are they going to react? And, KPMG was one of the first ones I told, and they came back to me and they said, well, we're going to pay you their whole contract. We're going to treat you like we treat our employees that go on maternity leave. They get the time to come back and be with their families. And financially, I was in a great place. That wasn't the issue. It was more, to me, it was more just the support. Like, we're here for you. We believe in you. And so we kind of told my other sponsors just so they knew it was happening. And all but one at the time did the same thing. And so now, my hope is it's written in contracts. It's not just, hopefully you've got a nice person behind the scenes, that it's in a contract. And I'd like to see it in all sports. You've got Allison Felix here at track, and I know they've had huge issues with that as well. Like, I want to see this in everybody's contract. So you're not making a choice of, okay, do I just keep playing golf and then wait to have a family, and then maybe it's too late.
Well, Stacey Lewis, we got to leave it there. But thanks so much for taking the time. I know you're busy. You got to get out on the course right behind me here and get some of your practice rounds in ahead of this weekend. Best of luck.
Awesome.
Stacey Lewis, thanks so much.
Thank you.
We'll be right back.
Kava took the market by storm when it IPO'd on Thursday, soaring to more than twice its initial $22 price tag, now trading just over 38 bucks a share. The fast casual restaurant has ended the IPO drought. Could there be more to come? Joining us now is Dan Primack, Axios business editor. Now, Dan, you recently sat down with Kava chairman Ron Shaich. What do you think, I'm going to throw in a pun here, was the company's secret sauce, if you will, when he reflects on last week?
The company's secret sauce from Ron's perspective really is its type of food, which is kind of Mediterranean, which is something we haven't really seen done at scale in fast casual. It is this type of food that is the actual number one diet. You know, when people look up diets and sort of food they should eat, number one recommended by physicians. So from his perspective, it was this kind of niche of a niche, and fast casual, you know, a niche of the overall restaurant industry that wasn't yet being served.
You know, it's so interesting, Dan, it's Julie here, because just because something is delicious, and I will say I'll cop to being a Kava fan, doesn't mean it's going to be successful from an investment point of view, right? I look at the Sweet Green example, and I wonder, because I know you talk to a lot of investors and talk to a lot of deal makers, what the appetite, is for deals like this right now and for offerings like this right now when the capital markets have been largely closed. I mean, Kava was kind of a surprise.
Yeah, Kava was a surprise. And again, it's a little bit of a one-off. And there are definitely some differences between it and Sweet Green, particularly when you look at the unit economics and also even a little bit of the physical locations in terms of geography of where they've each focused. But in general, I think what Kava says is that institutional investors, those hedge funds, those mutual fund managers, are indeed once again interested in new issues after taking 18 to 24 months off. There aren't going to be a bunch more Kavas per se in terms of fast casual chains that are going to go public. There's just not a huge pipeline of those. But the fact that there are investors who are willing to look at a new name could get a lot of other companies who do very different things, SaaS companies, et cetera, interested. And in the next 2 weeks, or next week and a half, really, we're going to probably see 3 more IPOs, one from an energy company, one from an insurance company, and one from a retail company, kind of a thrift store operator, all of which, again, are very different. If those each or 2 of the 3 are successful just in terms of where they price and trade, then you could really see, if not a flood, at least a pretty good wave after Labor Day.
So, Dan, I want to expand on what Julie was just talking about, especially like Kava. I mean, this could be a fad. I mean, and look at their numbers. They still posted a loss last year. They say they're on this path to profitability. Do their expansion plans indicate that they won't just be a flash in the pan, if you will? Sorry for another pun.
Well, look, I mean, for sure, if you looked at Sweet Green, 3 or 4 days after it had gone public, you'd see the chart would look fairly similar, right? A good price and then a big spike, and obviously it's come down over time. Kava has very, very big expansion plans. They want to be there. They're 250, 260 stores, I think, right now. They want to be at 1,000 or so in several years. They are plugging lots of money into this business. There's a time will tell. It is certainly true the fast casual chains become essential to people and then sometimes get kind of so ubiquitous that they become uncool, that they essentially become, kind of arguably what's kind of happened to Starbucks or McDonald's to a certain extent. Companies that do very well, but it's no longer that experience. You don't usually say, hey, let's all go out to lunch at McDonald's if you're at the office, whereas people actually might have 40, 50 years ago. It's a risk, but right now, early on, their bet is that they're going to end up becoming more like Chipotle than like Sweet Green.
And switching gears, because your purview is pretty broad, Dan, in terms of what you cover in the deal space. I was noticing your coverage of Blue Owl this morning, which is a capital management firm where there is some infighting that looks like it's going on. But it's not just there. I've been reading about Two Sigma, which is another firm where there's infighting, or O'Day Capital Management, which is a different situation. There's alleged sexual assault involved with that is causing the implosion of the firm. But it's just that there are these visible sort of blow-ups within that world right now. Do you think it's a sign of anything bigger?
Not necessarily. I mean, as you said, the sexual assault one is obviously separate than anything that's happening. Blue Owl, there's no allegations of any wrongdoing at all. It seems to just be a real culture clash between 2 organizations. Blue Owl was formed via the merger a couple of years ago of 2 different organizations, which culturally were a weird fit in the first place. And kind of, it's kind of like you've had kind of mild friction for years, and now it's kind of just gotten raw over time. No, look, when you've got very successful, very powerful people, as you can have, when you have co-founders co-founders of a firm, or again, founders of two different firms or co-founders of two different firms. These are people with very strong personalities and very people who are very confident in their view of how things should work going forward. And clashes kind of are part and parcel of that.
Yeah, it does seem like it when you get these big personalities, right, who have certain ideas about how things should be invested. And then while we have you, there's one more I want to sneak in, Dan, and that has to do with what looks like a bidding war for Vice, or at least a lot of interest in that media property. And I know some of your colleagues are covering that as well. Is Vice a hot property right now? Do you expect there to be? No.
Well, no, it's not. Well, let me rephrase that. I'm sorry. It is a hot property in the sense of there are a lot of suitors who are looking for it, but they're all looking to get it at a very cheap price, because it is obviously, you're talking about a company that was valued in the billions and billions of dollars by the private market just a couple of years ago. And we're now talking about bids that'll be in the low hundreds of millions. So it's hot. It's hot like a fire sale is hot, right? There's a bunch of people who are around it, but it is not the crown jewel that it was just a few years ago.
Yes, indeed. All right, Dan Primack, thank you so much for covering a lot of different stuff for us, Axios business editor. Good to see you.
Thank you.
The Department of Health and Human Services is being hit with lawsuits, and it could get worse, starting with pharmaceutical giant Merck suing to block Medicare drug price negotiations, calling that program unconstitutional. Could we see others? Joining us now on this is Yahoo Finance reporter Anjali Khemlani, and it seems like we are already seeing some others.
We are, but not in the way that you might expect, with companies lining up the way we thought might happen. And that is part of a UB analyst note that I'll get to in a second. But as we were waiting for this segment, we just got another lawsuit, as you mentioned, Julie, from the trade group Pharma. And that is including the National Infusion Center Association and Global Colon Cancer Association, this time citing the 8th Amendment. So what we have is a bunch of lawsuits citing either the First, Fifth, or now 8th Amendment, calling the IRA unconstitutional. We've got, of course, freedom of speech. And then fifth, you think about it as pleading against incrimination, but they're using this in the context of government seizing property, calling that the forced sale of the drugs through there. And then the 8th Amendment, which, as you know, would be criminal and cruel and unusual punishment, is now being cited for the part of it that deals with excise tax or excessive fines. And they're saying that forcing the companies to sell at the rate that Medicare sets would fall under that. So that's their argument. And the way that they are filing these suits against the health department, we know that Merck and Bristol Myers Squibb are the two companies that came out alone to sue separately, aside from trade groups. But we've also seen some interest from some of the other large pharma companies that might be targeted based on they being the drugs that might, fall under the parameters of being negotiated because they're top sellers, and therefore that's the target for Medicare. But in a UB analyst note, we saw some thoughts that maybe these companies won't come out individually and follow suit of Merck, really looking at the political considerations considering the election next year. So in a quote, the analyst said, our legal expert checks indicate potential for multiple other manufacturers to join the fray, but that others may choose not to litigate based on political considerations. And that could include a number of things, of course, the election next year and what that turns out to be, but also what's going on right now with, the Democratic stronghold in certain committees, for example, in the Senate, namely Bernie Sanders at the Health Committee. So a lot of things going on that would, really incentivize them to not put a target on their back ahead of time. So we'll just have to see if that really does pan out or if others do join. But very much a topic of conversation right now, and something where these companies are really feeling the pressure as it gets closer and closer to negotiation time.
Yeah, so we'll see if any of these various efforts at blocking it bear fruit. Anjali, thanks for tracking it for us. Appreciate it. And you want to stay tuned for our 3 to 5 p.m. show today. Jennifer Schonberger will be bringing us an exclusive interview with Atlanta Fed President Raphael Bostic. That's coming at 3 p.m. Eastern Time, and you don't want to miss it. We'll be right back.
Brian Sazi, Brad Smith, Yahoo Finance fam, you know what it is. We're here at Cannes Lions in France, where we're bringing you coverage all week with the leading CEOs and CMOs of some of the household brands you know and love.
With all these ad execs here, Brad, I think I just have to buy something from someone.
What are you gonna get?
I don't know.
Maybe a drink.
We've got more big interviews in the next hour on Yahoo Finance. Coming up, protecting your portfolio. We'll talk to one financial advisor about how the Fed's hawkish pause could impact your savings account and long-term investing goals.
Then Bitcoin sees a sliver of optimism. The cryptocurrency rallying today as traditional financial firms like BlackRock and Citadel are betting big on crypto.
We'll talk to Chris Ferraro, Galaxy Digital President and Chief Investment Officer, on how institutional investors should be allocating crypto. And we'll head back to Cannes, France later today for Brian Sazi and Brad Smith's interview with Tim Mapes, Delta Airlines Senior Vice President and Chief Marketing and Communications Officer. You won't want to miss that.
Something tells me they don't need anybody marketing them to convince them to buy a drink, but we'll have to check in with them later to find out. Let's do a final check of the markets before we leave you here. We've got stocks that are in the red pretty deeply in the case of the Nasdaq here, down by 1.2%. We still have Jay Powell answering questions from the House Financial Services Committee, and he emphasized that the Fed is committed to its 2% inflation target. Rochelle Akufo has you for the next hour trading. Have a good one.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Fed Chair Jay Powell's congressional testimony is underway. He's telling lawmakers that nearly all Fed members expect to raise rates this year after the central bank took a breather this month with a so-called hawkish pause. And we're across all the Fed speak, including our own exclusive conversation with the Atlanta Fed's Raphael Bostic later on today. You won't want to miss that. And another shock inflation reading out of the UK, boosting bets for more rate hikes from the Bank of England. The BOE not the only central bank that could opt for a big move on rates in the coming days. However, we take a look at the global picture this hour and call it the Bitcoin breakout. The world's top cryptocurrency continues its ascent, jumping almost 10% in the last 24 hours. Is it the Fed pause, or is it the big moves by some major financial players? We get under the hood of the rally coming up. But first, let's check in on the major indices and see how they're faring. Some of that talk there from Powell saying he's committed to that 2% inflation target, really not helping markets today. The Dow, they're off about 12 points though, just ever so slightly in the red. The S&P 500, they're also down about 0.5%, they're at 18 points. The Nasdaq taking the biggest hit so far, down 158 points or just over 1%. Let's also check in on the Treasury market as well. Not seeing so much of a flight to safety here though. We're seeing the 5-year up ever so slightly, about 0.86%. The 10-year also up over 1%, and the longer-term 30-year yield also up 1.1%. Well, Fed Chair Powell's semi-annual testimony on the Hill is underway. With inflation easing across categories, jobs stable, and recession concerns growing, Powell is defending the FOMC's hawkish outlook. He said in prepared remarks that nearly all FOMC participants expect to raise rates later this year. Well, joining us now with an update on how the hearing is going is Yahoo Finance reporter Jennifer Schonberger. Jennifer, what have you heard so far?
Hey there, Rochelle. That's right. Fed Chair Powell testifying right now before the House Financial Services Committee says as the central bank looks to raise rates higher, it's really the ultimate level on interest rates, not the speed at this point, that's most important. Take a listen to what he said just a bit ago.
The level to which we raise rates is actually a separate question of the speed with which we move. Earlier in the process, speed was very important. It's not very important now. The sense of the summary of economic projections and the decision really is just that, given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace.
So far, Republicans on the committee are slamming Fed Chair Powell for the potential for proposed higher capital requirements in the aftermath of the failure of Silicon Valley Bank. Fed Vice Chair of Supervision Michael Barr is undergoing a holistic assessment of capital requirements right now. Committee Chair Patrick McHenry expressed concern about Barr's idea yesterday, Tuesday, to do reverse stress testing, which would look to essentially improve banks' resiliency by heaping on capital requirements as a threat to get banks to fix issues quickly. McHenry said Barr is, quote, pursuing a massive increase in capital standards for medium and large institutions, and that this would limit banks' ability to lend and starve consumers and small businesses of capital that's needed. Representative Andy Barr, a Republican on the committee, went as far as to say that Powell should revisit Dodd-Frank to ensure that Barr, the vice chair of supervision, is only recommending, not writing preferred capital requirements himself. Powell said in response to all of the Republican concern and criticism, quote, we want to be careful not to regulate smaller banks to the point where their business models are really challenged by the largest banks. He said that any increase should really be justified. Now, Powell also getting peppered with many questions on the failure of Silicon Valley Bank and what the Fed could have done and is doing now. Powell saying that it's clear better liquidity requirements are needed and that if higher capital requirements were in place when SVB failed, perhaps the situation could have ended differently. Rochelle?
Indeed. I know he's getting a grilling there on Capitol Hill today. Thank you for getting us up to speed. Jennifer Schonberger there for us.
Thank you.
Well, the Federal Reserve may be done with big rate hikes, but the same isn't true for the rest of the world. Taking a look here, 40% of investors forecast a 50 basis point rate hike for the Bank of England tomorrow. The same is expected for Sweden and Norway. Joining us now on this is Thanos Mamvakidis, Bank of America Global Research Head of G10 FX Strategy. Thank you for joining me this morning here. So I first want to start with the Bank of England here, especially after this incredibly hot inflation reading that came in here. What are the next steps for the BOE at this point?
Now, the market has priced more for tomorrow, 33 bips, so not exactly 50, but somewhere in the middle. We expect 25. Definitely the Bank of England has more to do, but it is likely that there will be cautious. They will prefer to spread the hikes over a number of months to also wait and see more data. The market now is pricing 6 more hikes by 25 bips or even sooner if they go with 50 by the Bank of England. This is quite a lot. If the Bank of England goes at a relatively slower pace than what markets expect, they may be able to do less. But there is no doubt that they have to go further than other central banks, given that inflation now in the UK, if we focus in particular on core inflation, is reaccelerating. It is very challenging for the Bank of England because the economy is weak, but at the same time, they're dealing with a very stretched labor market. Wages are increasing. So they have not managed yet to contain inflation pressures, which seem to be getting stronger.
And we are used to seeing central banks sort of working in concert here, but especially in the UK, where you sort of add the compounding factor of things like Brexit, and they were just coming out of the EU and trying to figure things out. What does this mean when you're trying to look at the picture of central banks and how they're affecting the US central bank's actions?
One can argue that this is not only for monetary policy to address, and actually there is the risk that if central banks do most of the heavy lifting, they may cause unnecessary pain in the economy. You need fiscal policy to be in support by tightening. You need some structural reforms, particularly in the UK, that they're still dealing with the implications from Brexit in order to support monetary policy. So everything should come together. Similarly, in other countries, there is a concern that fiscal policy actually might be loose, offsetting in some cases monetary policy tightening and forcing the central banks to hike more than otherwise. It is interesting that the labor market is extremely tight in every single G10 economy today. So there is no excuse for central banks not to keep policies tight and in some cases to tighten further, given that the employment actually has been so resilient.
And I know that you're also tracking a lot of the FX action as well. I mean, the US dollar has been relatively volatile this year, but still far above where it was at the beginning of the pandemic. What's your outlook for the second half of this year for the US dollar?
We believe it will remain strong. It can get even stronger. We actually forecast euro dollar at 1.05. Now, the dollar is not as strong as last year because last year there was a perfect storm of negative shocks. Things look better now. However, as long as inflation remains sticky, as long as the Fed needs to keep rates high or higher for longer, this will continue supporting the dollar. Other central banks are also hawkish, but the Fed dominates here. And given that we believe we need the landing of the economy for inflation to drop sufficiently, this will also be negative for risk assets, and through this channel can support the dollar. So in our baseline, you get a landing of the economy by the end of the year, the dollar strengthens, and this is what it takes actually for inflation to come down on a more sustained path. And then next year, we can see the dollar weakening. For next year, we have euro dollar at 115 on the way towards the long-term equilibrium, which is 120.
And so what are some of the signals of the key currency pairs that you're watching? What are they flashing about the economies here?
Now, a key assumption here is that central banks will remain committed to fighting inflation. We do believe inflation will be sticky everywhere. The easy part is behind us. The reduction in headline inflation we have seen was because of the drop of energy prices, and the supply-related bottlenecks from the pandemic are behind us. But what remains now will be much stickier because it has to do with the stretched labor market. And we believe that things will be much more difficult for central banks now because the three conflicts of price stability, financial stability, and employment, the three mandates will come into conflict. Now, we assume that as long as inflation is so high, central banks have no choice but to ignore, in a way, the other mandates and focus on inflation, which suggests the higher inflation, the stronger the currencies. If any central bank blinks with the first signs of weakness in the labor market, for example, that will be negative for the currency. The UK here is a very interesting case because what we saw today after the inflation data, sterling actually weakened, which is not the typical correlation we have seen in the rest of G10. This is because the market is telling us that the macro mix for the UK is particularly difficult, and the fact that the Bank of England will have to hike more is not supporting sterling through the rates differentials because it creates risks for the economy, actually. So these are the kind of correlations we have to look at, and actually the central bank policy reaction function as it becomes increasingly difficult to reach the inflation target.
And we know that Jay Powell is currently, under a lot of pressure from Congress. They're asking, why are they still expecting to raise rates at the end of the year, and really worrying about something in the economy breaking by doing this. What are your thoughts?
Well, I think the Congress and governments and fiscal authorities should do their part of the job and should tighten fiscal policies. Actually, we can debate whether monetary policy is tight enough or not. Most likely, I think the terminal rates that the market's pricing are right, but I think central banks will need to stay there for longer than markets expect. But we're very concerned that fiscal policy is very loose. The vast majority of advanced economies today have a structural deficit, which means adjusting for the cycle, they have a deficit. They are adding fiscal stimulus in the economy as we speak. In the US, the structural fiscal deficit is projected to increase this year and next. In the Eurozone, they suspended the EU fiscal rules during the pandemic. The pandemic is over, the energy crisis is over, they have yet to bring the fiscal rules back. In the meantime, there is a temporary revenue overperformance because of inflation, which governments, instead of saving it, they spend it. So actually, fiscal policy is making the job of central banks, the Fed, the ECB, and the other central banks much more difficult today. Central banks have no choice but to keep policies tight, given that inflation is multiple times the target, given that core inflation has been sticky, and given that fiscal policy is not helping them by being too loose.
They're certainly staying the course so far. A big thank you to Thanos Vanvakidis there, Bank of America Global Research Head of G10 FX Strategy. Thank you so much.
Thank you.
All right, taking a look at Marathon Digital shares up after Bitcoin prices surged above $28,000. The crypto buzz comes after the launch of EDX Markets, a crypto exchange backed by Wall Street firms, including Charles Schwab and Citadel Securities. Investors are feeling confident about the institutional interest in the crypto sector, which could secure its future in US crypto stocks, some of which have been under pressure since the Securities and Exchange Commission charged Coinbase and its rival Binance for allegedly selling unregistered securities. Still, some investors worry that the crypto buzz might not last given the regulatory pressures that shape the industry. And we'll dive deeper into the state of crypto later in the show with Chris Ferraro, Galaxy Digital Chief Investment Officer and President. All right, coming up, we've got more market coverage just ahead. Plus, building wealth in the face of market uncertainty, what more rate hikes could mean for your long-term financial goals. Stay with us. According to analysts from JP Morgan, Amazon could finally edge out Walmart as the top US retailer. The company benefited during the pandemic, and analysts say the online space is dominated by Gen Merch, and Amazon Prime is a powerful market share tool. We're joined now by Yahoo Finance's Ali Garfinkel to discuss this more. Hey, Ali.
Hi, Rochelle. The message here is this from JP Morgan. Amazon's long-term e-commerce growth is intact. And that's despite a rocky few years, right? Legendarily, it's been a really up and down time in e-commerce. We saw that pandemic boom and then a pullback in 2022. A stat for you. 2022 marked the first year since 2009 that US e-commerce grew under 10%. And now JP Morgan is actually expecting to see 2023 show some growth, especially from Amazon. For 2023, JP Morgan is modeling Amazon's U.S. gross merchandise volume growing more than 11% to $477 billion. That's also while they have more than 42% of the U.S. e-commerce market in terms of market share. Now, if this does come to pass, Amazon will beat out Walmart as the country's largest retailer in what would be, frankly, a momentous shakeup for both companies. It would mark a new chapter. And of course, Amazon getting ahead here does not mean the fight is over by all means. If anything, what I'd say is that it will cause there to be a heat up in the battle between Amazon and Walmart moving forward.
Yeah, it certainly does put them in the spotlight, and Amazon does seem to already be in a tight spot at the moment. Senator Bernie Sanders announced that he's starting an investigation into Amazon for their safety practices. What can you tell us about that?
Yeah, Rochelle, this isn't the first time that Bernie Sanders has really made a move on Amazon, asking them to improve their labor practices, and I suspect it won't be the last. I was doing some texting around yesterday with some analysts on Wall Street, and none of them for the time being are expecting the Sanders probe to have any material effects on Amazon's bottom line. However, what this does bespeak is kind of a larger trend that we're seeing in terms of increased federal scrutiny, both on big tech and on Amazon especially. Let's look at today, right? Today, the FTC sued Amazon, alleging it's tricking customers into signing up for Prime and making it more difficult to cancel. What the FTC and Chair Lena Connor saying is that this is a violation of the FTC Act and the Restore Online Shoppers Confidence Act. And this has been a long time coming. This is an investigation the FTC has had going into Amazon Prime for about 2 years. So federal entities, right, the federal entities investigating Amazon ultimately are piling up here. And the thing I keep thinking is, if everyone's trying to land a punch on Amazon, someone's going to get a blow. The question is just how substantial that blow will really be, Rochelle.
Indeed, we'll be keeping track of that. Thank you for getting us up to speed. Our very own Ali Garfinkel. Thanks so much. All right, now time for our chart of the day. Goldman Sachs says it's now less likely the US will enter a recession in the next 12 months. The investment firm lowered its probability expectation of a recession to 25%, still well below Bloomberg's estimate. Goldman saying in a note out Tuesday that the lower probability reflects modest spending cuts from Congress's debt ceiling agreement and the view that the turmoil in the banking system will only modestly impact GDP growth in the year ahead. All right, well, Fed Chair Jay Powell telling Congress this morning more rate hikes could be on the table to combat that stubborn inflation, just 1 week after the Fed pressed pause. So with that in mind, we're seeing that with the unknown ahead, many investors are wondering how the Fed's campaign could impact their personal long-term financial goals. Let's bring in Gen Wealth Financial Advisors co-owner and managing principal John Shrewsbury to discuss this more. Hey, John, good to see you this morning. So anytime the Fed speaks, people are like, of course, people are asking, what does this mean for my money? So what does a hawkish pause mean for people's investment strategy and their saving?
Well, we were feeling pretty good about this when it all came up that the Fed was going to pause. And then Jay Powell comes out today and says, hey, there may be more rate hikes. I really think that the Fed may be following my grandfather's philosophy about taking medicine. He used to say, well, son, if a little will do a little good, a lot will do a lot of good. And I'm not real sure that really applies when it comes to rate hikes in the economy. What the Fed really needs to be doing is trying to balance the slowing of the economy to cool down the inflation that we've seen over the last year to 18 months. And at the same time, not choke off the fuel that drives the engine of the economy. Consumers are dealing okay with higher interest rates. We're seeing the housing market respond pretty well with housing starts for new houses increasing about 26% in the last month. So those things are good, but too much of a rate hike can really be a problem. And I would really think that the Fed should take a look at maybe pausing a little bit more and seeing the effect of what they've already done before applying more rate hikes and then being in danger of really hurting the consumer, hurting businesses and their access to capital or their cost of capital when it comes to borrowing.
And they did try to give themselves a bit of an out, obviously still saying that they're data dependent and they'll sort of see where things go, but still expecting at least a hike at some point at the end of the year. So with that in mind then, what does this do to recession concerns and how people should be perhaps getting their financial house in order if you've got inflation still up and some of these recession fears on the verge as well?
You know, the market has been doing really well since October. The market is up this year, the S&P about 15% as of Father's Day. Now, we're seeing more volatility in the market this week, and primarily because of the concerns about Fed interest rate increases and things of that nature. Those things kind of go hand in hand. And as long as the Fed is sitting there with their finger on the trigger, the consumer is going to be cautious. We've seen consumers being cautious about how they want to invest their money. There's way more money in money market accounts today than there ever has been. And we really are having a hard time talking to people about getting that money to work in the economy and the markets. And so I think that there's always going to be this wary eye that the consumer has on what the Fed is doing, and that's going to temper their ability or their intention of putting more money to work in the markets and the markets heading higher into the short term.
And we have seen, a lot of people, they're trying to chase those high yields. They're not interested in risking anything in the markets right now. But how would you advise them to approach the markets then? If outside of sort of chasing the high yields, what should investors and some of these people be focusing on when they're trying to grow their finances and not just rely on chasing these high yields?
Yeah, Rochelle, this is really where the rubber meets the road as far as all of this is concerned. The last 18 months of volatility that we've had in the markets and what have you are a very, very exquisite case for planning. This is something that takes a little bit of time, and because we're all busy, a lot of people try to kind of, eschew planning and say, I'm just going to invest some money. I'm not going to worry about what the plan is. But here's what we know. The longer term your plan is and the longer your commitment is to equities in the market, the greater the probability is that you have a positive or a really good rate of return on those investments. You should be planning for your long-term future, not necessarily playing the market against what the Fed may or may not do. That may affect your short-term return on the market, but you're not investing for the short term if you're young and investing for retirement, or if you're even middle-aged and investing for retirement, or as a matter of fact, if you're approaching retirement, you're still going to need money in 15, 20, 25 years that needs to grow to keep pace with inflation. And the only two asset classes that have really been able to do that are equities and real estate. You can get distracted by all the talk about what's going on right now in the economy and get your eye off that ultimate future state that you want your finances to be in. And we think that planning is really the answer to that, because it allows you to have some patience and allows the markets to do what they're going to do, and you can take advantage of what the market's going to give you.
So for some of the big ticket items that people tend to buy, whether it's sort of looking at a home or getting a car, is now a good time to do that, or should they press pause at the moment?
Well, if the Fed potentially is going to raise interest rates more and they're going to finance that purchase, be it a home or be it a big ticket item of some big appliance or something of that nature, now may be a better time to pull the trigger on that than later. I don't think that if you're trying to decide where you're going to live for the next 10 or 15 years, you need to be playing a game of wait and see what the Fed does, because you could be on the wrong side of that. I think you go ahead and buy that house or what have you, as long as it makes personal financial sense in your economy. Don't pay so much attention to the economy. Pay attention to your economy. And if you can afford that house at these current interest rates, then go ahead and pull the trigger on that, because it is something that you desire, it's something that you need, and you could be facing higher interest rates in the future by waiting and playing that waiting game.
Indeed. Plus, you also have the option to refinance down the line once rates do go down as well. A big thank you there to John
Absolutely.
Shrewsbury, General Financial Advisors, co-owner, managing principal. Great having you on today.
Thank you so much, Rochelle.
All right, coming up, crypto is seeing an influx of investors from the traditional finance space. We'll dive in deeper with Chris Ferraro, Galaxy Digital Chief Investment Officer and President. Over the last 4 days, Bitcoin is up 20%, nearing a 52-week high. Let's throw it over to Yahoo Finance's Jared Blickery for more on today's Bitcoin price action. Hey, Jared.
Hey there. Nice to see some action here because Bitcoin was taking a little bit of a snooze. Here is the 5-day price action. That 20% was from a low, the absolute low, to the high. And here's a 7-day look. We've seen some bouts. Bitcoin was already poised to break out, and we've seen little fits and starts here, but we have had some news over the last few days that has been potentially acting as a catalyst. EDX is a brand new exchange. It's being launched in partnership between Citadel, Fidelity, also Schwab, and that has been in effect here. That's giving some support to the notion that Wall Street is still behind Bitcoin and also developing blockchain as well as other digital assets. In addition, WisdomTree and BlackRock have now filed for cash Bitcoin ETFs. We know that there's been a slew of regulatory information that's been bad for Bitcoin, going after Coinbase, going after Gemini. Well, this is a little bit of good news because if these entities are filing for the cash Bitcoin Guess what? That means that maybe they know something. I think the market's getting perhaps a little bit ahead of itself, but it was due for a breakout. And I'm just going to show you. This is a 1-year price action. A little bit messy here because we do follow candlesticks, but here we have this nice rally in place since last December. This is a bull flag, and the market was consolidating, and it was poised to break out as we've seen, and potentially we do have some of these news catalysts. So good to see. Perhaps at least the market, at least a couple players, Wisdom Tree and BlackRock, think that Gary Gensler might finally rubber stamp that cash Bitcoin ETF.
Well, we'll see. There's been a lot of resistance so far, but thank you for getting us up to speed, Jared Blickery, there for us. Looking at Bitcoin climbing towards $30,000, its highest level since early May, as more traditional finance firms are betting big on crypto initiatives. Investors are pricing in more of an upside since the news of BlackRock's Bitcoin ETF filing. But will the bullish sentiment stay? And if so, for how long? Well, for more on the crypto market, we're joined by Chris Ferraro, Galaxy Digital President and Chief Investment Officer. Thank you for joining me this morning here. So on the one hand, I mean, you have BlackRock entering this space here, and even Invesco applying for a spot Bitcoin ETF in conjunction with Galaxy Digital here. What does this mean when you have this sort of institutional push coming back into the fray?
Yeah, good morning. Thanks for having me. Yeah, look, while I can't comment directly on the filing with Invesco that we were involved in, I think investors should take away that, you know, this is anything but bearish for the future of institutionally adopted, regulated cryptocurrencies, not just in the US, but globally. We chose to partner with Invesco almost over 2 years ago now, and we set out with a goal of creating and launching and co-branding institutionally compliant and regulatory compliant access vehicles for investors to touch and own and get exposure to digital cryptocurrencies. We're starting with the Bitcoin ETF. And Invesco is one of the largest ETF issuers in the world, and so we're excited to partner with them. We think it's about time that the U.S. entered the fray in terms of providing exchange-traded regulatory products for retail investors to get access to cryptocurrencies. Other geographies around the world have already launched these products, and there's no reason why the U.S. can't jump back into the fray and actually take the lead. And we think doing it the right way and partnering with Invesco is the right way for us to do it.
Now, for a lot of people who are sort of, you know, your crypto purists, I know some of the social commentary I saw online described this institutional push as the wolf entering the hen house. Do you think that's fair, though, when you think of what we've learned ever since the FTX debacle about sort of the need for some of the, perhaps the traditional finance aspects, along with the innovation that comes with the crypto space?
Yeah, no, I think this is actually a natural evolution. I think the innovation always tends to be messy and fast and then have to reset itself. And we've seen that through technology cycles over and over again. And there's no difference in cryptocurrency. The market has made huge strides in terms of technological advancement, in terms of launching new technology for networks that have higher throughput, higher security, sort of meet all the criteria for actually launching decentralized and secure blockchains. And 2022 was really a unfortunate negative catalyst where that innovation and need to break things first really caught up with the industry. What's super exciting and actually I think heartening, and what everyone should take real careful notice to, is in the background all along, traditional financial institutions, banks, broker-dealers, custodians, retail platforms, you name it, have had dedicated teams building and are now at the point where, while the old industry players a lot of them have stepped aside or have been forced aside, they are stepping into the market. And this is a good thing, because those providers stepping into the market are going to provide the safety and the security for global adoption of the asset class for all investors to feel comfortable taking exposure. Which historically was for only the most crypto native and sort of seasoned investors, a thing that they could do safely and soundly. So I think it's a natural progression. I think everyone should view that as wildly bullish, not just for cryptocurrencies, but for the future of tokenization and the digitization of all assets that we touch.
So how should institutional investors be positioning themselves? Obviously, you have now a lot more coming to the fray here. If BlackRock is able to get through, that certainly would open the floodgates here. How do they determine how they should be allocating here?
Yeah, I think it's sort of the same framework that we've touted for years, and it's sort of obvious, right? Like, start with Bitcoin. Bitcoin has been the bellwether of the space since its launch well over a decade ago. It has the most money invested in terms of security, in terms of track record of the network performing, and now you see these access vehicles coming out focused on launching a Bitcoin spot ETF. Anecdotally, or it as well, Bitcoin, from a performance perspective, while the headlines will tell you it's a volatile asset, when you actually look at the math, Bitcoin has been a top performing risk-adjusted asset globally in the world. Better performer than the S&P, better performer than the Dow, better performer than all the financials combined, including JP Morgan and Goldman Sachs, better performer than gold on a sharp ratio risk-adjusted basis. And so that should tell you that it should fit quite nicely into any investor's portfolio, 1%, 2%, 5%, quite mathematically, quite simply. And look, I think it's not often that you get to add a high sharp ratio risk-adjusted returning asset to your portfolio that also gives you the ability to take advantage of what is a global growth trend on the digitization of assets, on the digitization of store of value, and the moving of value out of the analog world into the digital world. You get to play all that at once with actually a secure, strongly performing asset. So we say start there and allocate appropriately.
So then for people who usually tend to sort of lump Bitcoin in with all the other crypto tokens, then when you're differentiating them, then outside of Bitcoin, what else looks attractive for you as perhaps what could be the next one to have like a catalyst here? A lot of people looking at Ether and Ethereum, but that's a very different use case for Bitcoin.
Yeah, I think differentiation in cryptocurrencies is incredibly important. I'm not in the business. We're not in the business of necessarily trying to point out the next speculative cryptocurrency that for one reason or another might go up more than Bitcoin. Bitcoin is an obvious rock steady start. It's been the best performing asset. Ethereum is the next natural place to go. Ethereum, you should think about as a bet on the decentralized technology future, the decentralized internet. Whereas Bitcoin has really found its lane as a digital store of value. It portends to potentially also go after payments long term, depending on how the network scales. But it's not being used for that today. It has a clear lane to run as a digital store of value. Ethereum is a bet that people should look at as do we believe over the long term, particularly as we start spending more and more of our lives digitally. Dare I say the metaverse? I won't, but all of us spend a lot of our lives on our screens, and as we start to move value out of the real world into the digital world, will we trust big corporations like Facebook, like Apple, like Netflix to basically be the gatekeepers of all of our value? And I think proponents of cryptocurrencies and decentralized networks think that is not a pretty future and creates a lot of risk and will actually not help adoption of individuals moving their value and their lives digitally, which we think is an inevitability. And so the bet on Ethereum is that that is a future that people understand and want to have as the underpinning of not just our financial system, but also sort of our daily lives and how we own and move value in and out of the digital and analog world.
See, and that's why it's important to differentiate the crypto so you really understand what it is that you're investing and betting on for the future. A big thank you for breaking all of this down with me, Chris Ferraro, Galaxy Digital President and Chief Investment Officer. Thank you so much.
Thank you.
All right, coming up, we'll be flying over to France once again, where we'll be hearing from Delta Airlines SVP and Chief Marketing and Communications Officer, Tim Mapes, about the state of the industry. Stay with us.
Well, it's the summertime and the weather is fine, but it's all business out here in Cannes. We are sitting right now with Tim Mapes, who is the CMO and Chief Communications Officer as well at Delta Airlines. Tim, great to have you here with us today.
Thank you very much. It's great to be with you guys. And hard to say this is work.
Tough assignment,
sure.
Tim, right?
Yeah, tough duty, duty.
Really difficult. The breeze was kicking up a second ago, so
yeah,
that was really bad.
The hardest part.
But now that we think about the juncture that this conversation, this festival is taking place at, critical time for marketing. There's so many questions around marketing budgets, AI, and if we start there on AI particularly, there's a question about how many jobs AI is going to take in the future. Marketing budgets have already been slashed. Restructuring has already taken place as well. How many, realistically, jobs do you think AI could take in the marketing field?
Well, I think when you look at screenwriters right now, you wouldn't think creative endeavors necessarily would be under siege to a thing like AI, and yet it is. Certainly things like bill processing and some basic things, some perhaps HR transactions and things would be the first to go. I think there's pretty good headlines around telemarketing. Thankfully, we're not in the telemarketing business. But it's yet to be determined. And I think the way we view it is more augmenting the staff that we've got. If you're a customer care person or a reservation sales agent, the ability to have the speed with which that information comes to you to better serve a customer frees you up to be more carefully listening to what might be going on emotionally with a customer. And the other thing that people aren't talking about is customers' use of AI as it pertains to interacting with businesses. In fact, the head of Google, when they led with AI, the example they used was a person writing to an airline seeking a refund and showing how AI could help create something. So it's not just our use in AI and threatening jobs within an industry. It's actually how we're all going to interact with AI as a technology with customers as well, using it to interact with us.
And so that's where my brain went next, because it's all about a customer experience at the end of the day. And marketing is one side of it, but where the customer experience really benefits or also gets hindered by AI is, I think about my own experience. If I'm sitting there and talking to a bot previously or some form of artificial intelligence, how does that better the solution that I'm getting at the end of the day too? And so where do you see that being infused into the operational side of Delta?
I think if you'd find it fascinating to know that to become a reservation specialist at Delta takes 16 weeks of training. Some of that training is dealing with all the complexity of perhaps a complicated, what's called a PNR, passenger name record of reservation. And so whether it's flight information and all of that somebody's got to gather, to the extent that that would push to your screen and that frees you up as that agent interacting with a person to actually be empathetically dealing with the non-rational, the non-factual things that you're beginning there to say, okay, I see that. How might we best help you? To us, it's augmenting as opposed to replacing, and it's accelerating so that it reduces the amount of time a transaction or an issue may take to resolve.
It's been an interesting time post-pandemic, Tim, within the airline industry. Pilot shortage, stories of baggages being lost. How do you get over that consumer anger from a marketing standpoint? How do you go out and market to people that already are very agitated by the airlines?
Yeah, I think you focus on doing the basics brilliantly. You have to be safe, you have to be on time, you have to be clean, you have to be reliable, but you also have to be warm and caring and elevated in terms of the way you're interacting with customers. And our experience isn't that vitriolic hatred, it's quite the opposite. The number of letters and the comments that we receive around thank you for, and it comes down to really, in our case, the Herculean efforts of frontline Delta people doing things in a moment. Sometimes our net promoter scores go higher when something's gone wrong because a person asserts themselves into a situation and addresses a customer issue in a way that they might not have expected. So even in problem areas, there's an opportunity to demonstrate as a culture and as a service brand your willingness and your ability to do more for customers. And so we don't see, of course, I think we get 1 million complaints a year. Every single one of those is a gift because every one of those is an opportunity for us to be better at something that frustrated someone along the way. But we get far more letters of compliment and far more letters that go into Ed's inbox every week that we just use to repurpose the stories internally to say thank you, frontline employees, for doing the things you do that are just heroic. They're magic. And it's just incredible to see on a daily basis.
And we're very much living still, Tim, I think, in a sluggish economy. Many would agree. How is your ad budget or your marketing budget for the second half of this year?
Strong. It's funny. because the recession that is hitting many now was us 2-3 years ago, right, with COVID. What we're seeing right now is, I think Ed calls it revenge spending in travel. There's $300 billion of money coming back into travel because it's always historically tracked GDP, no matter what, even after 9/11 and things. So it cycles back, and we believe there's $300 billion of travel yet to be spent on travel. And if you look at right now, we're sitting here in beautiful Cannes, France. We have 620 flights transatlantically a week, and that's not enough, right? Our plane coming over yesterday was just completely packed and sold out. So there is this kind of unrelenting demand for experiences because people already fixed up their house or fixed up their yard, and they did that a year or two ago. Now it's like the realization that we're all actually mortal, and boy, what an opportunity to come visit places like where we are right now.
This year, believe it or not, Tim, is almost over, and we're thinking about 2024, especially with guys in your position. We're going into election season. Are you concerned about putting marketing dollars to work in an environment that might be as polarizing as the last election?
Yeah, of course. I mean, it would be naive to think that 24 is not going to be the most divisive, kind of vitriolic narrative that we've seen. But I always think that the beautiful thing about communication and what we do as marketing is the answer to all of that is more communication, right? Getting out and sharing what is it that you believe in, what do you stand for, and let the chips fall where they may. But you've got to be true to yourself. I think some of the instances we've seen recently are people who go out with one thing and then backtrack and flip and flop, and then they frankly alienate both sides. It's much easier to be really clear what you stand for, and that to the extent others aren't for that, that's just going to have to be okay, because strategy is as much what you're not going to do as what you are going to do or be.
Tim, thanks so much for taking the time here today. We appreciate the conversation.
Brad, Brian, it's great to be with you both. Thank you for having us.
Thanks so much, Tim. Send it back to you guys.
All right, our Brad Smith and Brian Sozzi there. Thanks to them. All right, coming up, the Carver IPO was a hit in the markets, with the stock continuing to hold a price target of $38 US. But what about other restaurants? We'll be taking a look with Yahoo Finance's Brooke De Palma. A foodie craze could soon hit Wall Street. Shares of the Mediterranean fast casual chain Carver soared in its public debut. Now other restaurant chains are gearing up to follow suit. Yahoo Finance's Brooke De Palma is here with more. So Brooke, what chain can investors expect next?
Good morning, Rochelle. Well, that's right. Kava soared in its public debut up to $42 per a share, even higher than that, valuing the company at roughly $4.8 billion. Now shares, as you just noted, hovering around $38. But one expert telling Yahoo Finance that Kava is certainly a very promising signal for the IPO market. Matt Kennedy of Renaissance Capital saying that on Thursday, investors can expect Korean barbecue chain Gen Restaurant Group, commonly known as Gen Korean Barbecue House, to list on the Nasdaq under the ticker GENK, that is. Now, co-founders and co-CEOs Jae Chung and David Kim actually bootstrapped the company. They both have backgrounds within the restaurant industry, one of which opened locations of Denny's and Carl's Jr. The first location opened in California back in 2011. And in the S1, the company noted that they have successfully opened profitable restaurants in multiple new markets. They now have 32 locations. As you can see there, revenue 12 months ending March 31st brought in $169 million with average unit volumes of $6 million. And another chain that investors are certainly keeping an eye on is Fogo de Chao. That is the Brazilian steakhouse chain and opened its first location back in 1979. CEO Barry McGowan, he previously served as president, then took the helm as CEO back in 2019 prior to the pandemic. And in addition to that, there's no date yet on when exactly we can expect this company to go public, but it is expected to list on the New York Stock Exchange under FOGO. Now, it's important to note here that this company was previously listed on the Nasdaq, but it was acquired by Roan Acquisition Group back in 2018. Panera Brands, another company that is certainly buzzing. It was supposed to go public back in late 2022, that is, with via SPAC with Danny Meyer's Union Square Hospitality Group. It's now expected to go public by the end of 2023, according to Renaissance Capital. Of course, that is a combined merger that happened back in 2021 of Panera Bread, Einstein Bros Bagels, as well as Caribou Coffee. The Einstein Bros Bagel current president and CEO is expected to take the helm on July 1st. And so certainly a company that we're keeping a close eye on. And what's unique about Fogo de Chao as well as Panera Brands is that these are not new to investors. They both have previously listed on exchanges before. And Matt Kennedy telling Yahoo Finance that somewhat de-risked the deal to a certain extent.
Exciting stuff. And of course, my mouth is watering, giving me all these great ideas right as lunchtime is about to hit. A big thank you there for breaking all of that down for us, Brooke to Pharma. All right, well, let's get you a final check of the markets as we head into the noon hour. Still looking at a negative picture here, although some of that selling action has slowed down a little bit. We're seeing the Dow here now just slightly in the red here, down about 3 points. The S&P 500 there also down about 19 points. The Nasdaq, though, still under pressure. They're down about 1.3% or 171 points. That does it for now. I'm Rochelle Akufa. I'll be back with you at 11 a.m. Eastern tomorrow. See you then.